I think the market, has probably some near-term upside.
We do remain a bit more cautious on the long end of the curve.
When we look at the equity market, we see more risks on the downside than the upside.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
What's going to drive things higher? And then it's got to be the environment and earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. All eyes still squarely on Washington, D.C., with President Trump working the phones to wrangle votes for the one big, beautiful bill. Trade tension still high, even with a possible phone call between Xi Jinping and Donald Trump on deck. And the drip feed of economic data continues with the latest read on factory orders and job openings coming up today at 10 a.m. Eastern. Just a note, John is on a well-deserved vacation. Annmarie is on assignment. I would be here by myself with a white flag, but alas, we got incredibly lucky, and Damian Sassower has agreed to join me for the next 3 hours. Damian, thank you so much for doing this. I really can't thank you enough.
Oh, no, thanks for having me here. I mean, I love to be here. Let's get after it.
Are you having fun?
I'm having a lot of fun.
Honestly, I was looking.
I think the makeup department's having a lot of fun this morning on me also, to be honest with you.
Well, I will say I was looking today at the series of different news that potentially could be swaying markets one way or another, and I was struck by the budget down in Washington, D.C., and how it's steadily gotten an increasing amount of attention. How much is this really going to dictate so much of the mood in effect, given the fact that bonds have been responding so much in lockstep to this?
Well, it's all about the 30-year, the price action at the 30-year. And you remember last week when we saw the move in the 30-year, that was kind of driven by that poor 30-year JGB auction. And just last night, we had a JGB 10-year auction, which came in pretty good, but we have another 30-year auction coming up in Japan. We're going to see whether that spills into the long end of the U.S. Treasury curve, or whether you're right, maybe it is the big, beautiful bill and the rising fiscal deficit in the U.S., which is driving the zoo steepener, as Cam Dawson likes to put it.
I'm sure you will get all into the zoo steepener. Meanwhile, overnight, we did get a Truth Social from President Trump talking about how the one big, beautiful bill does not increase the deficit, does not necessarily cut Medicare and Medicaid. It doesn't necessarily do anything other than just give people tax breaks and continue with their policies. How much do you think Wall Street's listening? How much do they think that there is some faith that ultimately there will be some fiscal discipline in Washington?
Well, I mean, that's a very good point. And I really don't know. But I will say this, the Senate is definitely going to make their mark on this bill. I think, they are the adults in the room. They're going to try to do whatever they can. But from what I understand, President Trump is pushing through. He's working the phones. He's trying to push through its current iteration. And just how successful he's going to be is going to have a lot to do with whether or not you're right. The end of this the 30-year portion of the U.S. Treasury curve really kind of reacts to that. I mean, I'm not so sure it will.
In the meantime, can we ignore the trade issues, or is that something that people are still paying attention to? How much has that actually been priced in with respect to a possible falling apart of the U.S.-China truce?
Well, it's funny because these steel tariffs, everyone's been pointing to that being a China issue, but it's really more of a Canada and Mexico issue from where I sit, So I think what you're seeing is the Trump administration sort of readying itself, steeling itself for those negotiations with Mexico and Canada, which are our two biggest trading partners right now.
Meanwhile, what you can see is a buy-the-dip mentality that has been taking hold pretty much across Wall Street. This morning, you do see a bit of softness, but this is where we were yesterday. If you take a look at markets right now, down about 0.4%, about where they were yesterday, and we ended with a positive tilt. Euro actually falling versus the dollar, weakening. A little bit of dollar strength. Let's see if that can hold. Yields marginally lower. This is the kind of price action exactly on the heels of what Damian was talking about, that successful 10-year Japanese bond auction. And then you have crude just a touch lower. But, to me, I think that might be one of the most interesting things, the buy the dip mentality. And actually, that is what we got from Max Kettner this morning from HSBC, where he said that is the reason why he is a buy the tip kind of guy. This is incredibly bullish action to see everything really get bought, even with some of these lingering concerns about trade.
Well, Lisa, after declining slightly in the first quarter of this year, the U.S. economy is running hot at like 4% quarter over quarter right now in the second quarter. So, and look, inflation, I mean, if you look at JPMorgan's forecast for inflations over the 4-month period from May to, let's call it August, CPI is going to be running at something like 6%. So you're right. Where is this catch up of the hard data to the soft data? I mean, we all wish the Knicks had 9 games to beat the Pacers, but that's just not the case. We're all going to be sitting here waiting for the hard data to catch up.
And we all wish that the Knicks could have caught up to the Pacers, but alas, there we are. Coming up this hour, Cameron Dawson of NewEdge Wealth and the latest market swings. Rob Casey of Signum Global Advisors as Trump urges the Senate to pass his tax package. And Leland Miller of China Beige Book as the White House pushes for trade talks with with China. We begin this hour with stocks pairing gains on renewed trade uncertainty. Cameron Dawson of NewEdge Wealth writing, the market has shown signs of resilience as it burns the overbought condition from mid-May. We think the pain trade is still higher. Cameron joins us now. And Cameron, it is so good to have you. Thank you for being here. A lot of people agree with you. And that's what we saw from Max Kettner this morning, where he said recent dips in risk assets have been very short-lived amid less supportive news flow. Our sentiment and positioning indicators are still flashing buy signals.
We still come back to that positioning indicator from Deutsche Bank, consolidated positioning, which shows that we're still just in the 23rd percentile. So despite a nearly 20% move, you still have so many people sitting on the sidelines. Now, that's important to note. It's institutions sitting on the sidelines, mostly these systematic traders. It's the lowest numbers in things like the CTAs as well as algorithmic traders, whereas you see the discretionary traders have gone a little bit more all in, as well as retail. Retail has definitely been buying the dip, and that's where we've seen the greatest flows into this market. So because you still have people sitting on the sidelines, though, we do think that it comes down to the pain trade being higher.
Does it matter that we don't have a trade deal, that the budget is being negotiated? Do any of these things that I opened the show with matter?
Yeah, we do think that they matter, and we're calling this the summer of mud. So it's a lot less exciting than hot girl summer or brat summer. It means that we're just
You're crushing it, by the way. Carry on.
It means that we're just stuck in this muddle through, which means that from a policy perspective, we don't see a lot of things that are ultimately stimulative. We think that even if you do see the pain trade be higher, you still have valuations that are rather high, earnings estimates that have room to come down. So we still think that we're stuck in this sideways choppy range, a really muddy outlook from a growth perspective. So the summer of mud is what we get.
Well, Cam, I mean, I'd love to talk about stocks and bonds, but for me, it's all about the dollar. I mean, off 9% year to date, worst start since 1973. So, for me, the Trump administration tariffs, just how much runway does U.S. dollar weakness have in the current environment?
I think we should all be raising our eyebrows at a dollar that can't rally as the stock market rallies. And the dollar is not oversold yet. It rolled over, it broke through or tested 98 yesterday on the DXY. If that breaks, we could be talking about 95 on the DXY, which again is a challenge, mostly when we consider the environment that the Fed is set to be more tight than what we're seeing out of the ECB and other central banks. Usually you would think that that would translate to a stronger dollar, but now it's not, and it's all because of trade, tariffs, as well as what's going on with these budget negotiations.
Well, Cam, you make an excellent point. The correlation between the U.S. equity market and the U.S. dollar has tightened significantly. So let me ask you then this. Let's fast forward to payrolls. If we get a weaker print, can we see a lot of dollar weakness? If we get a better than expected print, is the dollar going to strengthen off of that? What's your view there?
Well, I do think that we have to have this through the looking glass kind of perspective when it comes to market reactions. We do think that if you do see a weaker print on non-farm payrolls, the first order reaction is a lower 10-year bond yield, lower 30-year bond yield, meaning that we get a rally across the curve. If payrolls mostly come in below 100,000, then it's a guess of what the dollar does. The other important thing about the dollar that we have to note is that futures positioning is incredibly short, meaning that everybody is now positioned for a weaker dollar. So as the pain trade in stocks could be higher, the pain trade in the dollar could also be higher.
Are we getting a little bit carried away? When I talk to a lot of investors and I ask them, is U.S. exceptionalism over? Are you seeing this massive flight of foreign investors from the U.S. market? They all say no. They all say that actually their foreign investors that they deal with are not shifting away from the U.S. en masse at all. They might express displeasure. They might use corporate executives as their bouncing off points for how much they are concerned about policy, but they're not actually taking action with their dollars. And actually, they do have confidence in corporate America. Do you think that that's not true, or that that's on the brink of fading?
B of A just published a survey that showed that you have seen $138 billion annualized into equity flows from foreign buyers this year, which is nearly at the record that we saw $155 billion last year. So as much as we have had this narrative that nobody wants to buy U.S. assets, we're still seeing inflows. The inverse of that, though, is that if you look at the inflows into U.S. bond funds, it's only been $3 billion. So people are still buying U.S. equities, but not buying U.S. bonds. The other thing to watch, though, is that revenge tax that's in the bill that's being considered. Could that mean that we see less demand for U.S.-based assets if we start taxing that passive income that's part of the revenge tax? Big question.
Yeah, that's a concern for a lot of people. Exactly what the ramifications of this bill. I believe that's 899, Section 899. There's a big op-ed challenging that in the Wall Street Journal today. I recommend people read it. It's sort of a compelling read. I'm curious going forward what you're looking for to understand whether this narrative has more legs to it rather than just simply a timing trade, maybe after a really strong period in the dollar, and frankly, some concerns about duration in the U.S. right now.
Yeah, I mean, I think that is the biggest question, is that do we see duration risk continue to be something that people want to avoid, even as yields test prior highs? We have seen people step in and buy dips within bonds at 4.8% on the 10-year, 5% a couple years ago. The question is, as you start potentially testing those levels, is the appetite for duration as much, given the fact that we are dealing with all these fiscal concerns? And I think the big question for us is whether or not the Senate's version of this tax bill is going to be even more deficit inflating than what we saw from the House, because of some of the considerations about not wanting to do as many spending cuts.
European harmonized CPI collapsed to 3% overnight. It was expected to come in at 3.8%. That all but solidifies the fact that the ECB is going to cut by 25 bips on Thursday. We've seen cuts from South Korea, South Africa, Indonesia, the whole slate across the world. Yet, if CPI is really going to be running at something like 6% over the next few months here in the U.S., just how much scope will the Fed have to cut rates in the face of all these other central banks being able to stimulate their economies?
Yeah, and I think the other thing to note is that a lot of these economies are dealing with much weaker growth than what we're seeing within the U.S. It's pretty wild to think that German unemployment is at 6.3%. It peaked in 2020 at 6.4%. So with weaker inflation as well as much weaker growth in the euro area, the ECB just has a lot more room to cut. And the Fed is telling us that they are in no rush to cut whatsoever, that they're going to look through some of this soft data that shows weaker, potentially weaker growth.
Right.
And note, the soft data is actually rebounding a little bit as we've seen some sentiment rebound post the tariffs being walked back.
Yeah, this is a real key question. How much will that divergence continue? And how much is the Fed actually not going to cut, especially if you do start to see growth falling off in a significant way? Cameron Dawson of NewEdge Wealth is also sticking with us for the hour, which we are so pleased about. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Senate Republicans are considering making significant changes to President Trump's tax bill. Senators are looking into the potential impact of a so-called revenge tax buried in the fiscal package. The provision would increase tax rates for individuals and companies from countries whose tax policies the U.S. deems discriminatory. Meanwhile, China's manufacturing sector slumped the most since September 2022, according to a private survey. It fell to 48.3 in May from 50.4 in the prior month, well below the 50 mark, separating expansion from contraction. The results were far weaker than the official PMI reading released on Saturday. And the government in the Netherlands has collapsed. Far-right lawmaker Geert Wilders announced on social media that he's pulling his Freedom Party out of the country's ruling coalition because the three other main parties refused to agree to his plan to curb migration. This move forces the Netherlands into a snap election. Otherwise, the next vote wasn't scheduled for another 2 years. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, looking for savings.
I want this to pass, but there's no reason that the Senate should just simply rubber stamp it when we can do so much better. I do think, though, by and large, it will look similar to the House bill, but we just may be able to find some other places for savings.
Rob Casey of Signum Global Advisors joining us next. This is Bloomberg Surveillance. coming back to a Tuesday with a little bit of losses, but this kind of feels like deja vu. It looks almost exactly where we were yesterday, except with dollar strength rather than dollar weakness. But what you can see is a little bit of weakness across the board, down about 0.4% on equity indices in the United States. Yesterday, we started the same way. We ended positive. Why? People buy the dip, and that is telling us something. That's something that Max Ettner underscored of HSBC this morning. Under surveillance this morning, looking for savings.
I want this to pass, but there's no reason that the Senate should just simply rubber stamp it when we can do so much better. I think it was interesting listening to the leader from the House say they don't think there's any way to find more savings, and I think that's really the thing we have to do. We will not be able to pass the bill without finding some more spending cuts. I do think, though, by and large, it will look similar to the House bill, but we just may be able to find some other places for savings.
Here's the latest. President Donald Trump trying to sway Republican holdouts on his one big, beautiful bill. Trump posting on Truth Social, I call on all of my Republican friends in the Senate and House to work as fast as they can to get this bill to my desk before the 4th of July. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, I want to start there. How much is there a sense that July 4th is getting further away, and some of these calls have to be made throughout the night even more so?
Yeah. Hey, Lisa. Good morning. Well, it's definitely an expedited timeline, but we can say that at least one senator, Senator Tom Tillis, a Republican from North Carolina, did tell reporters yesterday that the Senate is going to try to get a finalized package in the next 10 to 15 days over to the White House to review. Now, of course, a lot of different things actually need to happen as President Trump is dealing with conflicting demands from members of the Senate who say that they want to make their mark on this House bill. On one hand, you have a group emerging that is pitching themselves to be more fiscally conservative fiscal hawks, perhaps run by Senator Ron Johnson, a Republican from Wisconsin, who did have a call with President Trump yesterday and says he plans to meet with the White House's economic team. And at the heart of this is that Johnson says he wants to see deeper spending cuts. And he's also taken issue with claims that some of the tax priorities, like no taxes on tips or overtime pay, could really incentivize growth. But on the other hand, President Trump has to contend with those more moderate members who are raising concerns about really what's at the heart of the spending cuts, which are changes to benefit programs, including how quickly work requirements could be instituted when it comes to Medicaid, and also that the House plans to freeze the Medicaid provider tax and also shift some of that cost sharing on to states. President Trump doubled down in his post on Truth Social yesterday, saying that there would be no cuts ultimately to Medicaid, but we know there's a few different analysis out there, Lisa, including one cited here at Bloomberg News that projects about 7.7 million people by 2034 could ultimately lose benefit coverage because of shifting eligibility requirements.
Tyler Kendall of Bloomberg, thank you so much for being with us. Right now, Rob Casey of Signum Global Advisors here in studio. Rob, great to see you. I want to start there. How difficult is it going to be to get some of these Republican senators on board, given the fact that, as Annmarie said yesterday, they're all kings at a time of very slim margins?
Yeah, it's true. I mean, many of these senators, I think that the five that you all highlight are probably the five to watch. Many of them want to have their fingerprints on this bill, right? Generally speaking, the Senate sees the House as being an inferior legislative body, right? They want to write their own bills. They want to then force the House to vote for them. But in this case, there's only one king, I think, and that's President Donald Trump. He wants a one big, beautiful bill. He wants it as soon as possible. I think July 4th is a really hard deadline to meet, but I think by the August recess, he's going to be able to have everybody coalesce around this bill like they did in the House.
You said there's one king. The one king put out a truth yesterday that said that it doesn't increase the deficit, that actually it does everything good and nothing bad, and that everything bad is a Democratic fiction. Do you think that there are enough Republican senators who will just take him on his word?
I mean, the short answer is yes. Will they take him at his word? No, they're all pretty smart, right? They can read a pretty simple math equation, which is that this is going to add to the deficit. The thing about it, senators like Ron Johnson, among others, is that, well, first of all, Donald Trump can lose three of them, right, and still pass this bill. So it's not to say every single one is going to vote for the reconciliation bill. The thing about these senators, though, is they want to get reelected, right? And maybe some of them aren't reelected for another 2, 4, 6 years, but they need Donald Trump in their corner between now and then. And so, frankly, I do think that they will listen to the president. They will make their tweaks, no doubt about it. But the president himself has said that he's okay with tweaks, right? He's okay with some changes. And I think that's him setting up, going back to the House, and saying, yes, the Senate made some changes, right? Maybe SALT's a little bit lower, maybe the deficit expands a little bit further. You now have to eat this because we're in July, and I'm asking you to.
Rob, the focus is on future spending. It's on the bill. But I want to ask you a little bit about the rescission request that President Trump is sending to the Office of Management and Budget today, the one that's going to request for a $9.4 billion clawback on all that U.S. aid funding and public radio and broadcasting. Is that just the first of many to come, and will it be successful?
The first of many, I would say probably not. The truth of the matter is, right, we've sat around this table before for months talking about cuts, right? First it was Doge and Elon Musk. Second of all was all these cuts to Medicaid and to SNAP and things supposed to be included in this bill. Some of them certainly are. But I think the truth of the matter is that this Republican trifecta in Washington is learning what many trifectas in Washington have learned before, and that is there just aren't that many places to cut, right? And it's incredibly unpopular to cut. And so do we get this $10 billion rescission package? Yeah, I think it probably passes for the most part, right? There aren't that many Republicans out there who are going to defend, USAID, NPR, et cetera. These are their punching bags. But are we going to get a lot more of that? I think probably not.
Rob, we know where the cuts are coming from, the proposed cuts, that is, Medicaid, state and local tax deductions, EPA, clean energy credits, et cetera. But I want to know, where are the new tax funds expected to go? I heard shipbuilding, I heard air traffic control. Talk to us a little bit about where taxpayer funds are going to be redirected in the new bill.
Absolutely. Well, I mean, obviously, if you listen to President Trump, if you listen to him on the campaign trail and listen to him today, he's talking about no tax on tips. He's talking about no tax on overtime. Those have been really pretty significantly narrowed by the House and the Senate. What we hear from the Hill is that, honestly, Congress people aren't incredibly enthused about those policies. They don't see them as being pro-growth, growth-driving policies. I think that makes sense to a lot of us. But they understand that is what President Trump wants to, wants to run on. President Trump isn't running for anything, but it sort of feels like he is, right? President Trump is always in campaign mode. And so those are what they're pointing to. And then, yeah, I mean, to your point, there are some sort of shifts away from some green investment, some, a green energy spending to what I think we would think of as slightly more traditional, infrastructure investment, energy spending. But that shift is not all that significant.
Rob, not to get too technical, but will we be talking about the Senate parliamentarian this summer? Meaning, could we see her review of this bill potentially delay its ability to get to that July 4th deadline?
We definitely will be talking about the parliamentarian, potentially a lot, right? So all of this has to pass, and this is unique to the House, unique to the Senate. Not so much in the House. Everything has to have a budget impact, right? That's review for everybody here, everybody watching. But the truth of the matter is, a lot of these policies may not have a budget impact, right? You were just talking about Section 889. There's a huge question as to whether or not that is going to have an explicit impact on the budget one way or the other, right? And if it doesn't, the parliamentarian is going to say it can't be included in the bill. Now, Republicans have opened up the possibility that they're essentially going to not listen to the parliamentarian. They can do that. It's been done once before. I believe it was Senator Rockefeller at the time who didn't listen to the parliamentarian, moved forward with something, and then had to apologize about that profusely. But if you listen to Leader Thune, among others, there's a chance that they essentially go around the parliamentarian, and that is akin to breaking the filibuster, right? So that would be the nuclear option. It would certainly open the door for Medicare for all the next time Democrats have a trifecta.
And you mentioned that the Senate version could add even more to the deficit. How much more as we think about the long end of the bond market? Absolutely.
Well, I think that is where these 5 Republicans in the Senate come in who are going to kind of constrain this spending. I think Ron Johnson in particular is probably the majority maker here, right? The 50th or the 51st vote. They are going to constrain the deficit expansion from here. I think maybe a couple of months ago, consensus was that the Senate was going to blow out a lot of these spending cuts. I think the truth of the matter is most of the spending cuts stay in at this point, right? So the bill, I mean, we heard Senator Kramer, the bill probably looks relatively similar to what we saw in the House. Maybe the Medicaid cuts are pushed back out in terms of timeline, but in terms of the actual policy, like the teeth of the policy, I think they remain relatively the same.
Rob Casey of Signum Global Advisors, thank you so much for being with us. I imagine you get a lot of phone calls because everyone's a congressional expert these days, no?
Yeah.
It seems like it. Rob Casey there of Signum Global Advisors. You raised a great question, Cameron, which is essentially what will the bond market pay attention to? And what will actually trigger that Liz Truss type of moment that we've heard about, or the cracks in the bond market, as Jamie Dimon warned over the weekend?
It's one thing for you to say it doesn't add to the deficit, but we can all see the numbers. And so really the bond market's reaction, we do think bond yields would be lower if it were not this bill being debated right now.
Well, I mean, I think it's it's more, I mean, look, again, you mentioned it a little bit earlier. It's about positioning, and it's about position size, and it's about magnitude, and we just don't have any color on that yet.
I love that we're going to be talking about the parliamentarian, and I love that everybody is whipping out their Congress history books and understanding exactly how it works. We're also whipping out our future books when it comes to artificial intelligence. Coming up, Matt Wood of PwC on whether AI is coming for your job. The answer, it depends what your job is. This is Bloomberg Surveillance. A bit softer this morning as we head to the open. We've got 3 hours until the opening bell, and you can see futures lower just a bit. But this really feels like deja vu. It feels like what we got yesterday, down 0.4% pretty much across the board, although the mix is much better in the bond market with yields lower and the dollar market strength, something we haven't seen very often. 3 hours away from the cash open, here are your morning movers with Yahira and Anand. Yahira.
Hi, Lisa. We start with the check on Disney and Microsoft shares. Both are slightly lower after announcing fresh job cuts yesterday. Microsoft laid off over 300 workers, adding to the 6,000 jobs it cut last month as it shifts toward artificial intelligence. Meanwhile, Disney cutting several hundred roles in its film and TV divisions, mirroring what's happening across Hollywood. They're scaling back production as traditional revenue models come under pressure. So both companies navigating in major industry transitions, which of course have led to these job cuts. Next up, we have shares of JetBlue. Those are down more than 1% here after CEO Joanna Garrity clarified that their new partnership with United isn't a step toward a merger. She emphasized that after years of scrutiny from the Department of Justice, the company is playing it safe to avoid any regulatory issues. The reaction telling me here that maybe investors were hoping for a more transformative deal between the two companies. And last up, we have Bumble stock falling 5% here after JPMorgan hit it with a downgrade. The analyst saying the recent rally has gone too far, and with revenue and paying users expected to drop, they are setting a $5 price target on this stock. And the problem, they say, is that Gen Z is just not feeling the love with this app, which is the one where the woman messages first after matching. I wish Gen Z the best with their love life. Lisa?
Thank you so much, Yahira. Thank you for that. On our radar this morning, the Dutch government collapsing. Far-right leader Geert Wilders pulling his party out of the Netherlands ruling coalition. Joining us now is Bloomberg's Oliver Crook. Ollie, everyone talks about how Europe is the grown-up in the room. They're the one that actually has the cleaner shirt right now than the U.S. And now we have this. Please explain.
Yeah, flying a little bit in the face of the sell America, buy Europe concept that they're really trying to push the adults in the room. As you say, Lisa, this is really sort of the classic issue in Dutch politics, which is a question of immigration, a question of refugees, and that is what brought down the government about a year and a half ago. It took them about 7 months to pull together a government that now held for 11 months, and they just pulled the plug on it this morning. And it was pulled by Geert Wilders, who is the leader of the Freedom Party in the Netherlands. He is a sort of far-right candidate who is sort of very anti-Islam, very anti-immigration. And what he did is he went to the parliament with an ultimatum, 10-step program that he put before them. He said, listen, we need to get a majority of these 10 steps through in order to curb immigration. If we do not, I will pull the plug on the government. Some of these points were using the army to guard the Dutch border, turning away all asylum seekers, temporary halting family reunification, and sending Syrian refugees back to Syria, which he judges now a safe place. He said he was going to sleep on what he was going to do about it overnight. Then in the morning, 3 hours ago, he pulled the plug on the government. This is the biggest party in the Dutch parliament. So now the government has come down. They're going to convene in about 1 hour's time to discuss the next step. But what it will probably mean is an early election.
All right, Oliver Crook, thank you so much. Great reporting, as always. I'm sure we'll be coming back to you again throughout the day for other developments that have been going on throughout the continent, frankly. It has not been dull. Meanwhile, President Trump putting pressure on Republican senators to pass his tax package, making phone calls and posting on Truth Social that he wants that bill on his desk before the 4th of July. Damien, as a credit strategist extraordinaire, how closely are you watching all the details and dusting off your congressional description books?
Well, for me, it's all about recession probabilities, and I just can't understand, right? If we were running an effective tax rate here in the U.S. of 2.5% last year, and I think consensus expecting it to go to something like 15 to 20% by the end of this year, that the recession probability in the U.S. isn't higher or isn't probable as opposed to non-probable. And so I think the markets haven't woken up to the reality that the hard data will definitely follow if these tariffs kick in after the 90-day window.
The challenge is that there's so much of a lag here. We're going to get the inflation portion first, and then we'll possibly see the impact to the jobs market and to demand. So we've seen about 100 basis points come out of 2025 GDP estimates to about 1.4%. Is there further downside from there? I think is the question that we'll be answering as we go through the summer.
Speaking about tariffs, the White House saying President Trump and President Xi speaking potentially this week. We've heard this before. Both sides have accused each other of violating their trade agreement. Beijing has yet to publicly comment on potential talks. It just raises a question about whether this impasse is something that can be closed, Damian, or whether people have gotten overly complacent that they can put this particular story on the back burner.
Well, I mean, when you see the Chinese Navy circumnavigating Australia and doing live fire exercises in their EEZ, and then you see the U.S. responding by sending its own frigates through the Taiwanese Strait, I mean, the answer to me would be no. I mean, I don't see any real, any sort of agreement being reached in the near term. I think that's what the market needs to see here in order for it to snap back.
Is he being too pessimistic?
Well, we do think that it's like Trump is singing Carly Rae Jepsen, Call Me Maybe, to Xi, because he's just, we have all this intention that we're going to have discussions, but there's no discussions happening, which just means that for all the promises of deals that are going to happen, we've just seen no progress. So again, we wait through the summer to get that muddle through.
Cameron, do you have like a playlist that you go through
100%.
and you basically try to glean inspiration for all of your notes?
Yes, welcome to the Free Association.
Okay, yes, and so today was a bit of Prince and yesterday maybe a bit of Taylor Swift. Right now, let's get to some news just crossing the Bloomberg. Meta signing a 20-year contract with Constellation Energy to buy power from an Illinois nuclear plant. More evidence of technology companies' appetite for energy to run data centers and AI as the promise of that technology potentially transforms the world we live in. PwC out with its 2025 AI jobs barometer, which shows a link between AI adoption and productivity growth. Matt Wood of PwC joins us now. And Matt, you're answering the questions that a lot of people have been asking, which is basically how many of us are going to lose our jobs and become irrelevant because of some of this new technology?
Well, it's looking like right now, none of us. In fact, counterintuitively, the number of jobs and the wages associated to them are actually going up, not going down. So we looked at over 1 billion job postings globally from 24 different countries. And we found that for organizations, whether they were advanced in their AI use or early in their AI use, they had more job postings than they had before. We found that the productivity of people working inside those organizations was up. We found that the revenue generation for those workers was 3x higher than it's ever been before, and that the wages associated with those workers were also going up. And so it's a little counterintuitive to what maybe some other folks are seeing, but our barometer shows a very, very different picture.
A really optimistic look for people who have the tools, have the capability of using artificial intelligence and machine learning to actually become more efficient, become more relevant at a time where Microsoft is cutting hundreds of jobs because a number of people currently in their roles can be replaced by artificial intelligence. How messy could this transition be? Because even though there are some people who get paid more, be more productive, and be more in demand if they have those skills, there are going to be even more people potentially who lag behind that and can't catch up quickly enough.
Well, for sure, the way that we are going to work is going to change. And for those organizations that are furthest ahead on the AI journey, the skills are changing the fastest. And this is a very humane problem. This is not a technical problem. This is a problem that we have to work through with all of our workers, with all of our staff. And as leaders, we need to make really sure that we're investing to make sure that all of our workers in every industry have the access to the skills and the education and the upskilling to be able to take advantage of this dramatic productivity gain.
Matt, the courts are they just gave Donald Trump approval to take away 500,000 visas here in the U.S. What impact is that going to have on the AI sector?
Well, education is a remarkably vibrant place for AI to not just be used, but also to be created. Right. AI is very, very, very early. And a lot of the research that we need to do to advance the state of the art is going to come out of those sorts of organizations, those sort of institutions. Super important that they remain funded and remain active.
Well, Matt, let's talk data centers for a second because we got this big news in the market with Meta. I've seen some statistics that last year, for the full year 2024 here in the U.S., data center build-out accounted for roughly or more than 80% of the entire U.S. economy's capital expenditures for the full year. First we had Microsoft scaling back its plans following DeepSeek. Now we have Meta, buying or leasing a nuclear plant. Who are today's investors? Who are who's going to provide the long-term takeout capital for these data centers after all is said and done here?
Well, data centers are super interesting because they're not just data centers. It's actually more of a full vertically integrated stack of investment that covers an entirely new ecosystem that is being built out across industries because of AI. So if you think of just the real estate that those data centers have to sit on, the energy infrastructure that has to surround those data centers, the data centers themselves with all of their disks and their GPUs and all of the infrastructure required to house and cool them. Then you've got the large language models that sit inside that infrastructure. You've got the applications that sit on top of those large language models. So there's a full ecosystem that bleeds from real estate to energy to computer science to big tech, which just didn't exist before. And this blurring of industries into new ecosystems is happening around data centers because of AI, and I think we expect to see it across multiple different industries going forwards.
Given the massive investment we've seen from all these companies into AI infrastructure, how are you thinking about monetization? Mostly as you've seen competition pick up, what will the returns look like for all of this investment?
I think it's an interesting question. I don't personally see it as an investment that most organizations should be seeking a return from today. AI is more like intellectual infrastructure for your organization. We don't look at internet access inside an organization and say, hey, what's the return on investment of my bandwidth? Instead, you say, well, all of my work is done in a completely different way and in a much more efficient way and a much more productive way, 3 times more productive in the case of AI. What is the impact of not doing that? And so you see very, very few organizations today that don't enable broad, fast internet access to their organizations and to their teams. We'll see the same thing with AI. Most organizations will want for upskilling and retention and for hiring the very best people and keeping productive the people they've already got. They're going to want the most robust AI intellectual infrastructure inside their organization, similar to networking.
How advanced have companies been in the U.S. at adapting to some of these new tools, given the fact that it is quickly evolving? The bigger have an advantage with respect to data, with respect to resources. How much has this really bifurcated the sphere from big to small companies?
It's not so much big to small. It's actually, again, a little counterintuitive. So those organizations that we see moving the quickest are actually the regulated industries. So financial services, insurance, healthcare, manufacturing, those sorts of domains where the compliance with the regulations around that they've had to live with for the past 20 years and maybe have felt like a bit of a headwind, particularly around data governance and data quality. Those are all the things that you need to get right to be successful in artificial intelligence. And so whilst that headwind has been there, it's actually driven all the right investments for those organizations to be successful with artificial intelligence. And as a result, the AI piece is just a small incremental lift on top of that. And they're able to move much more quickly.
Matt Wood of PwC, thank you so much for being with us.
You're welcome.
Really interesting. And you raised a great question, Cameron, which is essentially how much can shareholders expect to get this back in their pockets?
We also know that a lot of these companies have massive margins on their legacy businesses. They're near monopoly businesses. So as they're investing in areas that have far more competition, do we see the total ROICs for these hyperscalers, for these Mag 7 names actually come down? And how will investors digest that?
Especially given the fact that it has to be a flip to the equal weight versus the NASDAQ, which is what a lot of people have been arguing, that if you get this adoption, you could see a bigger benefit through the rest of the S&P.
Well, Lisa, if you just look at the experience of companies like NuScale and TerraPower, these next-gen nuclear reactors require a 10-year build-out. So just when exactly is this going to be up and running for Meta? And when? I was under the impression that nuclear was going to miss the whole AI boom, but maybe I'm wrong.
We shall see. Right now, let's get a check on what else is going on around the world. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Russia and Ukraine held a second round of talks in Istanbul yesterday, but failed to reach a peace agreement, though the two sides did lay the groundwork for a new prisoner swap. Russia presented peace proposals that include Ukraine surrendering control of territory in 4 partially occupied regions, while Ukraine demanded an unconditional truce and proposed another meeting later this month. Meanwhile, Commerce Secretary Howard Lutnick says he expects the U.S. and India to strike a trade agreement before higher tariffs kick in on July 9th. He says President Trump's strong personal relationship with Indian Prime Minister Narendra Modi has made an easier path to trade negotiations with that country. And Toyota Industries said it received a $33 billion offer to take the company private. The deal will involve a tender offer for the shares of a supplier of textile looms, forklifts, and parts for Toyota Motors cars. A new holding company will be established to privatize Toyota Industries, according to the company, which says it plans to make an official decision today. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, resetting U.S.-China relations.
It has been a whirlwind, I think, in the U.S.-China space. President Trump, of course, has sent some mixed messages around what he expects and hopes from China. I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China.
Coming up next, Leland Miller of China Beige Book, who will talk about not only what that relationship could look like, but some of the economic data we've been getting that kind of conflicts with itself from China. This is Bloomberg. Just a touch softer today after yesterday's bounce, which really was, I think, the notable takeaway. Question will be whether we can repeat that today. Right now, down across the board, but not by much, considering the gains that we've seen after the biggest May return for a year, going back to 1990. Right now, under surveillance this morning, resetting U.S.-China relations.
It has been a whirlwind, I think, in the U.S.-China space. The very baseline issues between the two nations remain very much in place, even though domestic pressure forced both sides to bring those tariffs down. President Trump, of course, has sent some mixed messages around what he expects and hopes from China. I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China.
Here's the latest. The White House saying President Trump and Chinese President Xi Jinping will speak later this week after both sides accused each other of violating last month's trade agreement. Joining us now is someone with tons of context, both when it comes to strategy as well as when it comes to the economy in China. Leland Miller of the China Beige Book. Leland, great to see you. Thank you for being here. I want to start with this question of what is at stake in order to even get a phone call between Xi Jinping and Donald Trump, something that we've heard a couple times before, but that, from what we understand, hasn't yet happened.
A phone call should be very easy, but I think the reality is that the Chinese side is very skeptical that the U.S. side will keep whatever commitments that it asks for, and that it will convey exactly what it wants, and that it will have a point person that will be able to have the authority to be able to make a deal for what for whatever the U.S. side wants. So, a call is easy, a meeting is easy. There's nothing that you really have to give away in order to do that. But I think that in Beijing right now, there's a worry that if they come to the table and President Xi looks bad, then this will be a net negative for the relationship and for China's leverage. So they're holding off on that until they think that they have a better hand. We'll see if it happens this week.
Leland, the renminbi is up 1.5% this year versus the dollar, yet it's fallen in each of the last 3 years. I had a number of friends in attendance at the JPMorgan Global China Summit last week, and they all came away with this bias toward a weaker dollar. Does that mean a weaker dollar relative to the yuan?
Well, the dollar and the yuan are tied very closely together. I mean, we pretend like the yuan is a free-floating currency. It's not. It's pegged to the dollar. So if you have a weaker dollar, you're going to have pressure on the yuan to fall. But I think that China will want to keep it a little bit up relative to that because their bias is for a little bit of upside appreciation in a falling dollar world. So, yeah, if you have reciprocal tariffs and the U.S.-China relationship and all these other things weighing on the dollar and the dollar's falling, then the yuan will be pulled down a little bit, but they'll want to have a little bit of an upward bias from it. So, yeah, you should expect some mild, modest upward appreciation in a falling dollar world.
Leland, it was only a few years ago when multinationals claimed that they couldn't afford to pull out of China, given the economy's size, its overall influence. What are your thoughts on China as an investment destination? From the perspective of a U.S. institutional investor, is China investable now?
Well, I think you made a nice distinction between, institutional investors and those companies that are in there with hard assets and a presence throughout China. Very difficult to extricate themselves at that point. if you're an institutional investor and you're looking at China, then you have to be asking yourself, what edge do I have here? Am I just waiting for this ridiculous thesis of, things have been down for 11 years, but now they're going to bounce back in the stock market? Do you have an edge in a technology sector, but it's going to be closed off by export controls or by tariffs in the near future? It's not impossible to trade in China, but it's getting very dangerous. And most of the people who have traditionally done this have done this very lackadaisically. They look at, Chinese data. They've got a DC consultant that tells them a little bit about China, and then they buy a bunch of Chinese tech companies. You can't do that anymore. So if you're still in China, then you better have a tremendous edge in terms of investing there.
Leland, the Chinese 10-year rate is a mere 1.7%, near multi-decade lows. Is there any signal to take from that about underlying Chinese economic health, mostly as we consider the rest of the world where long-end yields are screaming higher?
Yeah, absolutely. There is a signal. If you look at our credit data, China Beige Book credit data, it's remarkable what's happening on the monetary easing side. I mean, we've seen rates continue to go down, 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 down. And this is a time in which there's elevated inflation elsewhere. So what they're trying to do is, on the fiscal front, they're manning arming the cannons. On the monetary side, they continue to cut rates. There's a downside to doing that because you're hitting the profitability of banks and you're hurting savers. But right now, they're just trying to keep the economy going during the early onset of these trade tensions, trade war 2.0. So they're cutting rates, but it has a lot of detrimental effect, downstream in the economy.
How much fiscal firepower do you think that China has? There seems to be an assumption that China has a lot more room than other countries around the world. Is that the case?
It is the case. What's interesting is that for several years, while every headline, we'd see every day was, China stimulus, promising stimulus, pledging stimulus, it was never happening in 2022, 23, 24. We got to the very end of 2024 and early 2025. We have a fiscal activity index that showed significant things were happening and a significant borrowing and bond issuance by transportation construction firms. So they were really getting ready for what might be a real downside scenario. We've seen that ebb off a little bit. So we have not seen the blast to any type of cannon, but they are preparing in a way very differently than they did the last 3 years. This should have been expected. China does not want to do big stimulus. But at the end of the day, they're going to have to batten down the hatches of their economy if they get in a larger trade tiff with the United States.
Which is the reason why, Leland, and I think that all of us are trying to get at the ultimate question, which is who has the most leverage? Who's in the better position economically right now as the U.S. and China go head to head? We got this data overnight that China's private factory gauge plunged the weakest going back to 2022. It went against some of the official data. Some people are saying it's messier, it's a smaller sample size. Do you think that China is hurting more or the U.S. is hurting more? Is it possible to even make that equation?
Well, look, first on the Caixin survey, I mean, we agree with the official data here. We're much, much bigger. We survey a lot more companies than Caixin does. And we actually saw an improvement in manufacturing activity. Not great. It's down from a year ago, but it's up from the lows that we've seen the last couple of months. So there's something there. There's a lot more resilience, both in the consumption side, which is surprising, and the manufacturing side, which is not, in China right now. So I would take that away from the economic data. So I think at this point, look, we have to be watching the data closely, but also keeping in mind that China is looking a little bit more resilient than we thought going into the Geneva talks and beyond.
Leland Miller of China Beige Book, thank you so much for your insights. Really helpful and interesting that the official data is more accurate in this case, according to Leland Miller, than the private factory gauge. Cameron, I'm going to ask you the question that Damien asked, which is China uninvestable, or do you feel like there are sections that you like because of that potential impetus from fiscal?
We've been finding a lot of opportunities within China, mostly on the tech side, where they trade at such massive discounts to what we see within the U.S. But we have to keep in mind that there's just a lot more volatility, a lot more uncertainty in investing in some of these companies, which is reflected in those huge discounts that they've been trading at.
Well, I thought you asked a great question. Brilliant. Talking about rate differentials between the U.S. and China, I'll give you this one. China and Japan, that 10-year is only 17 bips differential right now. I mean, China is the new Japan.
Well, maybe Cameron can find a song that represents that the next time that she's on. Cameron Dawson, hopefully it will be soon, because it was really wonderful to have you. Cameron Dawson, thank you so much, of NewEdge. Coming up next, Chris Harvey of Wells Fargo, Henrietta Treyz of Veda Partners, Marriott International CEO Tony Capuano, and Jason Draho of UBS. A real question here about the consumer heading into the summer. This is Bloomberg.
the economy is still, as of now, fairly resilient.
You still have a bigger growth engine in the U.S. than you have in most of the other parts of the world.
The gap between the what people call the soft data and the hard data has been pretty dramatic over the last few months.
It's just really hard to read the data right now.
The markets haven't really had to come to grips with the idea that the economy might be slowing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the second day of the trading day. President Trump back in D.C. and now everyone is focused on what the U.S. budget will look like given the fact that he is making the rounds, calling, whipping, trying to get votes to get the Senate on side. Meanwhile, we are expecting some sort of call between Xi Jinping and President Trump as that truce potentially starts to fall apart. And this comes as we still try to understand what the data means. We get, of course, job openings today. We get some factory orders data. We get some other ADP data tomorrow. Then, of course, we get that key non-farm payrolls report. Damian Sassower, so glad that you're still with us here today in the seat.
Thanks for having me.
I'm curious about whether this economic data on Friday actually is going to be the market mover, given the fact that very much front and center seems to be the deficit, seems to be a whole host of other policy considerations.
Well, you're looking ahead to Friday. I'm just trying to get through today. We've got durables. We've got auto sales. Auto sales are going to fall off a cliff this afternoon, probably. So, to your point, yeah, the payroll data definitely matters, but I think it's all about magnitude. Do you think that growth in the U.S. is going to slow off the back of this? Yeah, probably. But what magnitude? You think inflation is going to pick up due to tariffs? Yeah, probably. But what magnitude? So we're talking about magnitude here.
It seems like everything needs to get done all at once, right? And that seems to be the way that it has been going in Washington, D.C. for a while. Right now, the focus for the bond market very much has been squarely on the budget and what's going to happen with the deficit, given the fact that there are concerns about bond vigilantes and whether this fiscal overhang is going to be unsustainable. How much do you believe that actually is what's driving the bond market versus just a lack of liquidity, a lack of conviction, and the back and forth about whether we actually will see expansion and whether we can take recession off the table?
Well, look at who plays in the 30-year, right? I mean, these are basically lifers. These are pension funds. It's not a very big, deep investor community, and that goes for Europe and Japan as well. I mean, in Europe, Euro swaps, it's all pension schemes. It's the Dutch. So, to your point, I agree with you. I think it's positioning. I think it's finding a clearing price for these bonds that not a lot of people want to own.
Meanwhile, right now, what we're looking at is people actually finding bonds that they like. You are seeing a bid into bonds, which is different than what we saw yesterday. You're not seeing as much of that positive feel in stocks. If you take a look, equities just a little bit lower, even though you do see bond yields lower. This is a correlation people want to be seeing, and this comes on the heels of an auction in Japan that went better than expected. It was a 10-year auction that actually had pretty good participation that came, Damian, after an adjustment by authorities in Japan, particularly the Bank of Japan, saying that maybe they would stop rolling off their balance sheet. In other words, maybe we'll just absorb a little bit more of that to prevent some of this shakiness that we've seen in the bond market.
Well, I think the BOJ did the right thing last week in going to the market and asking them what their thoughts are. That just shows an openness and a lack of, just a transparency that you didn't see previously. So I think, look, the market is trying to come to terms with, where is that clearing price for the long end of all these curves? Where is term premia going to settle in here, not just in the U.S., but abroad?
The market is trying to grapple with how to get to summer vacation at a time when it seems like there is always a new narrative to be held. Coming up, we've got Chris Harvey of Wells Fargo as markets are whipsawed by everything, renewed trade concerns in particular. Henrietta Treyz of Veda Partners as the White House pushes for a call with Chinese President Xi and Marriott International CEO Tony Capuano on the outlook for summer travel, which we want to get to. We begin this hour with stocks lower, given back tech-fueled gains as trade uncertainty weighs on investors. Chris Harvey of Wells Fargo staying bullish, writing tariff risks both in terms of the news flow and actual effects on consumer spending are priced in, if not overstated. And with Fed easing on schedule, we see a constructive second half for equities. Chris joins us now. Chris, wonderful to have you. Thank you so much for being here.
Good to be back.
So the positive spin on this is that you do believe that there is not going to be some sort of inflationary wave from the tariffs and that Fed cutting is squarely on the table. Why is that good for equities if it potentially could come on the heels of some weakness?
It's good for equities. Well, lower rates, the Fed getting in motion is generally good for equities as long as it's outside a recession. And I don't see a recession, right? Credit spreads are still incredibly tight. If you look at the consumer, we can argue about how strong the consumer is, but the consumer is holding up pretty well. And when we look into the second half of this year, one of the things we haven't seen is really the positive effect of the change in regulation. We'll start to see that with a stress test. The other thing is M&A activity has been very muted. We've had a massive repricing here. The secular AI trade is out there, and it's going strong. I think the AI Diffusion Act or the mitigation of the AI Diffusion Act is still understated. And if we look at the consumer, right, if we really stretch, right, maybe 20% of what tariffs touch, the consumer spends on. And if we add 10, maybe 15% of that, and we assume that all of that, you're not looking at a big upward move in spending or a big hurdle for the U.S. consumer. And the U.S. consumer is very, very savvy. They're going to shift around their basket. They're going to look for where they find utility. And tariffs at this point in time, I think, are just overstated. The fear is more important than the fact, right? When I talk to people about fundamentals, they're like, yeah, fundamentals are actually pretty good. The soft data, we're really discounting the soft data because when we look at the prediction markets, they're telling us something else. When we look at the hard data, it's hard to find a really difficult story. And so people are afraid to be bullish, I think. But when they look at the fundamentals, it's hard for them to say, yeah, there's a recession looming. Hey, job cuts are looming, and the wheels are about to fall off the cart.
I hear you, and it seems like a lot of people believe that. HSBC's Max Kettner came out this morning and said, look, you see the buy the dip again, and it just highlights the strength that you've seen in the market. The pushback that I would say is the ISM manufacturing survey yesterday. Some of the commentary that we heard, this from the electrical equipment, appliances, and components sector. The administration's tariffs alone have created supply chain disruptions rivaling that of COVID-19. Then you have an unresolved trade deal with China will result in empty shelves at retail for many do-it-yourselves and professional goods. This, according to the paper products industry. How do you fully discount that?
Don't fully discount it. But the thing that we have to watch, and I think that's most important, is will we make progress over the next couple of weeks on trade and tariff? Will we have something from India, from Japan, maybe from the EU, North America? And if we do, you can start to look through a lot of that information. If we don't, then yes, things will start to come down to roost. We may get a lot more volatility, and you have to grit your teeth a little bit. But ultimately, I think we're making progress on trade and tariff, and I think we will continue to make progress on trade and tariff. And if so, you can start to look through that.
Chris, where do you and the team at Wells Fargo stand on where the U.S. effective tariff rate is going to be by the end of this year?
So we're thinking somewhere in 12 to 15%.
Okay.
I'm a little.
And that's not going to stoke a recession here in the U.S.?
I don't think so.
Okay.
I don't
Interesting.
think so. Right. I'm closer to 10. Like my philosophy coming in here was we should have just put a 10% tariff on everything across the board. They had Congress. They should have mandated it. Everyone understands the seller's fee, whether you pay that through Airbnb or the New York Stock Exchange or Amazon, right? That was easy to sell. The unintended consequences weren't as big as what we're doing right now. But if you get to 10%, think about it this way. A third is eaten by the exporter, a third is eaten by the corporation, a third is eaten by the consumer. That's fine.
So margins, corporate margins, the pass-through of these price increases onto the U.S. consumer, you think the corporates here in the U.S. are going to be successful in pulling that off?
So when we talk about corporates, right, what we're talking about a lot of times now is we're very positive or constructive on the AI trade, right? And if you're tied to CapEx and CapEx spend, it's a much different story than if you're tied to consumer and consumer spend. And so you can't just say corporates across the board. Right. If you're tied to the consumer, yes, there are certain companies, and if you look at some of the general merchandisers, it's been a little bit tough, right? If you look at some of the tech companies, not so tough, right? And our analysts have done a lot of work on data centers and what would happen to data centers if the tariffs stay in place. And the cost to data centers is actually 5% or less for building a new data center, and that's just not prohibitive in any way, shape, or form.
So we expect U.S. equities to rally through the end of this year, or maybe not, and certainly not in a linear fashion, but, just take me through the fact of which sectors are going to do the heavy lifting there. I mean, you talk about AI, I imagine you think it's going to be technology again.
We think it's going to be technology. We think it's going to be more your growth companies. If you look at the AI trade, it is a very robust, secular, U.S.-centric trade. And what is the S&P 500? S&P 500 is a growth index, right? I've been talking to people, recently people have been talking to me about mid caps and small caps and so on and so forth. And I think eventually they can work, but you need the Fed to get in motion. You need the Fed to start cutting rates. But if you look at the broader market is really driven by growth in technology, and growth in technology is okay right now. Actually, not bad.
So what's the risk event for you?
I don't like this whole taco thing that's being thrown about, and I don't think it's on deaf ears, right? So Trump doesn't want to be seen as weak; he wants to be seen as strong. So does he go out of his way to say, no, that's not happening, right? That's a concern, and that's a concern to other people. The concern is, hey, can rates go higher? Sure, rates can go higher, but I think the real concern is what we've been talking about or implying. If you don't know, you know. If at the end of June we still don't know what's happening when trade and tariff, then you have to start making some of those hard decisions. And that's the big risk. Because if you don't know, then I know that I need to start tightening the belt. I know I need to start bringing down costs. I know I need to start looking at labor, and that will start to cascade.
It's in June, so is the range getting a lot wider given the fact that you could have both of these things, especially given the Reuters report overnight talking about how there was a memo drafted to send out to all the trade partners today by the U.S. saying, hey, we want your best deals and we want them today?
Yeah, I think time is of the essence. Obviously, we've all seen what's happened with the VIX and volatility in the equity markets this year. This will not be a calm market. The market is expecting some sort of resolution or some sort of progress. If they don't get that progress and we go the opposite way and we start putting in more and more tariffs and not making progress, we're going to have a problem. So is the range of outcomes large? Yes, it's large. How do you handicap that? That's a much different conversation or question.
Have we learned anything in the past couple of weeks that has changed your allocations in any material way?
Have we learned anything?
In the sense of anything concrete.
That's a loaded question. No. Well, I pose this to a bunch of people. If you knew today, if we roll the clock back to the beginning of the year, and you know what you know today, what would you think the market would look like? What would you think the economy would look like? And most people said, I would have thought the economy would be in much worse shape. The economy is much better shape than people think, given what we have right here, right now. So what we've learned is U.S. economy is still robust. Some people think, and I think it's fair, right? There's a lag effect to trade and tariff, and maybe we'll see that. But ultimately, if we get that, not resolution, but if we get that progress, you can start looking through it. If you don't get that progress, really tough to look through it.
A really important month, and I'm so glad that you're going to be with us. Chris Harvey of Wells Fargo will be with us throughout the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Shares of Constellation Energy are surging more than 14% in the pre-market after it agreed to sell power from an operating Illinois nuclear plant to Meta Platforms starting in mid-2027. The deal could spur construction of a new reactor at the site as AI sends power demand soaring. Meanwhile, new details are emerging about the suspect in this weekend's attack in Boulder, Colorado. The FBI identified him as Mohammed Sabri Solomon, who came to the U.S. in 2022. On Sunday, he brought flowers and disguised himself as a gardener in an orange vest so he could get as close as possible to members of the Jewish group before attacking them with incendiary devices. And Elon Musk is selling $5 billion in debt for his AI startup xAI. It's the latest in a series of fundraising efforts across his business empire. Morgan Stanley is set to be shopping the debt. Musk has also raised $650 million for Neuralink and is selling $300 million in xAI stock through a secondary offering. He's so busy. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Maybe that's the good kind of deal making for a lot of these banks. A big question about whether it will pick back up in the second half of the year. Up next, pushing for a deal.
President Trump has talked about wanting to meet with President Xi. Has that call been scheduled?
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls.
Henrietta Treyz of Veda Partners joining us next. This is Bloomberg Surveillance. this market looks like it's going down, but it is not one that likes to end the day down. And what we're seeing right now is some of those losses getting clawed back as time goes on, which seems to be very much what we have been seeing over the past few trading sessions. The Nasdaq now down just 0.1%, the Russell 2000 almost flat, and S&P futures lower by 0.25%, which you can see in the bond space. And this is notable. Yields lower, and it is on the heels of Japan. It seems like Japan, Damien, is driving everything this morning.
Well, I wouldn't say everything, but if you look at the global ag, and most people don't realize this is the benchmark Bloomberg Global Aggregate Bond Index. It's up 5.5% this year, and the reason is most of those bonds are non-dollar denominated. So forget about the declining dollar and all the currency risk that's embedded within that index. Your bond portfolios, if you're diversified, are doing well.
Well, maybe not, though, if you're in the U.S., and that's a real question when it comes to some of the fiscal considerations. Under surveillance this morning, pushing for a deal.
President Trump has talked about wanting to meet with President Xi. Has that call been scheduled?
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls. The European Union came to the table thanks to President Trump's threat of tariffs. And now we are seeing that they are negotiating in good faith with our delegation. As you know, we are in discussions with many other countries around the world as well who understand the need to cut a good deal with this president and the administration.
Here's the latest. Reuters reporting that the Trump administration is urging countries to make their best trade offers by tomorrow. This comes after the White House says Trump will likely speak with Chinese President Xi Jinping later this week. Bloomberg's Tyler Kendall joins us from Washington. This as we hear about a trade deal with India potentially to be announced in the next few days. What do we know about the state of play, about all these deals that are being made?
Yeah, hey, Lisa. Well, it does appear that the White House wants to show some sort of forward progress after we really haven't gotten any sort of update since that agreement framework that was reached with the United Kingdom. And perhaps we're getting some clues as to why. We heard from NEC Director Kevin Hassett, who has previously said that deals really are imminent, say that ultimately China has been the, quote, laser beam of this administration's focus. And perhaps that's taken away some of the momentum towards other deals. Now, amid this Reuters report, we should say that it has, according to the reporting, has asked these other countries to come forward and put up basically their best offer, which of course would include a lowering tariffs, but also boosting some U.S. goods. We know that U.S. LNG and agriculture has long been a priority of this White House. And then how they're going to address those non-tariff barriers, which this White House has really been pushing, needs to be at the forefront of any conversation going forward here. Now, at the moment, Lisa, we still aren't quite sure exactly what sort of concrete details we are going to get. Of course, the U.S. is under active negotiations with those countries that have been prioritized, that are geographically close to China, such as Japan and India, with Howard Lutnick saying that he's optimistic a deal could be reached before that 90-day pause is up. And then also the European Union, which we know has sort of had this fire lit under it to try to get some sort of deal soon.
Bloomberg's Tyler Kendall, thank you so much, as always. And we'll be tracking the progress throughout the morning. Joining us now, Henrietta Treyz of Veda Partners. Henrietta, I'm wondering why the market isn't paying more attention to this. In particular, that Reuters story talking about how there could be a deadline in the sense that maybe there's a level of impatience as there aren't as many deals that have come to the fore as some had expected.
Right. We're at 0 deals in 60 days, and we need to get to 90 deals in 90 days. So I think the market is doing exactly what it did for the entirety of 2024. It's continuing to sort of trust in Trump. I hear it from crawfish boils to calls with clients. People are saying, well, it could happen. It could happen. And that's precisely what the administration's comms team delivers. When Caroline Leavitt says, I will tell you with certainty that there might be a call, that obviously suggests that there may or may not be a call. The biggest problem really is that most nations don't know what President Trump wants. So the biggest news item, and as you point out from Reuters this morning, is that USTR is saying, hey, bring us your best offer. And that's because the president has told us he's going to be sending letters instructing roughly 100 nations as to what their go-forward tariff rate is, and he needs an excuse to bring those rates down. If you're going to put 50% tariffs on a nation that does $293 million worth of trade with the United States, that's nonsensical. You do need a reason to put them at a much lower rate. And I think that's what the White House is searching for, a reason to lower rates and avoid the July 9th Liberation Day implementation.
Henrietta, you're down in New Orleans. I'm up here in New York City, but up in Westchester County, the residential real estate market, we like to call that going to highest and best. Let me ask you something. Going to highest and best, all cash, no contingencies, is that the right way to run trade negotiations with your trade partners?
It's funny. I'm actually from Westchester, so this is great for me. The highest and best idea is, come to the White House with anything. So what we're going to see, I'll point to the EU because I think that's one of the most important ones. And it's one that I think has the most risk for higher tariff rates, all the way up to the 20% Liberation Day rate, for example, is that we want to do agriculture trade with the EU. We want to have genetically modified poultry go to the EU. If you go to the EU and ask them if that's acceptable to their population, they will tell you no. Those political operatives will pay a price in Brussels should they agree to those trade terms. And that's the same thing we're seeing in Japan and South Korea as they face voters. And so the biggest question we have is it a good thing for nations to negotiate with President Trump, or is it seen as weakness on the part of their leaders? Australia and Canada would suggest that the strategy of being tough with Trump and coming with an offer, but not something that capitulates and gives away your national protected resources like agriculture trade, is really where folks stand. And that is, of course, the story of trade going back to the beginning of humanity. Everybody wins or everybody loses.
I want to link what we're talking about to what Chris Harvey, who's here with us this morning, just was talking about, that he's worried about the taco stuff, which is the Trump always chickens out kind of framing. Whether that's irked the president enough to say, OK, I'm going to take a hard line and go through with some of this. Do you get the sense that that actually is something that's increasingly on the table with some of this demand for the best offers by the end of today?
I think the taco stuff, if we're going to play what's your emotional response in the White House, then, that's a question for a therapist, I think, not for an economist. But what I do think, and I lived through the first trade war, is that there are very emotional responses and reactions that happen in the blink of an eye in the Oval Office. I remember them viscerally, and I can tell you exactly where I was, sort of like people can say, where were you when JFK got shot? I can tell you where I was when the List 3 tariffs went on. Those are a very big sort of knee-jerk reaction. The impulsiveness of this administration is a holdover from the first term. So I don't see this as new. If he's bothered by, investors calling him taco, I mean, get used to it. That's what Wall Street's like.
Henrietta, I have a question, right? So it sounds like you're not so optimistic on deals getting done in the short term. Paint us a picture. What do you think is going to happen between now and the end of June?
Sure. I think that we're going to get increased Section 232 tariffs. Specifically, I'm most concerned about pharmaceuticals, lumber, which is obviously critical for the housing market, including up in Westchester. I'm expecting Section 301 tariffs to rise. I'm getting a lot of questions from clients right now about the actual process. How many days does it take to conduct an investigation? How many days does the president need to notify the Federal Register or Congress or collect comments? And it's specific, 270, 90, 15-day delineations. And all of those are optional. The president has the authority to escalate Section 232 tariffs on steel, aluminum, automobiles, and automobile parts as it stands today. In the works are about 7 other items that will all see tariffs as he sees fit. All that Commerce needs to do is publish those reports. And then we have the Section 301 tariffs, which are, of course, covering all of our trade, $550 billion worth of goods with China. So I think what I'm seeing from investors in Wall Street is a focus away from sort of the macro, what's the global tariff rate, which I think is not a relevant conversation in this sort of questioning IEEPA space, but what sectors are going to be targeted. And so that's where I'm spending my time. I think that's where folks need to concentrate. All of China is exposed, and then pharma, semiconductors, et cetera.
Henrietta Treyz of Veda Partners, thank you so much. We saw this not so long ago with the auto sector, right? I mean, Chris, at a certain point, we saw that with respect to, is Ford and GM investable if they could potentially be in the crosshairs of all of these tariffs?
That's right. And the big concern is, does Lutnick come on and say, hey, we're going to roll out the electronic tariffs? Because that has big ramifications for a very important sector, the tech sector, be it the iPhone market, semiconductors, what have you. And so that has broad-reaching effects, and that's a concern.
I have to say with Henrietta, I know she's focused on the sectors, but I'm an emerging markets guy, and so I focus on the countries impacted. And I take your point, is India ready to do a deal? Is Japan ready to do a deal? If one is announced, just how quickly will the rest follow? Are they going to be like dominoes, or is this going to be a long, drawn-out experience?
And who feels like they have the actual leverage at a time where right now it had been that maybe the rest of the world would have the real pain. Now it seems like that's being turned on its head, at least so far in trading action. Coming up next, we'll find out about summer vacation and who's taking it. Marriott International CEO Tony Capuano on the outlook for summer travel, which should be happening. This is Bloomberg Surveillance. Coming into the second day of the trading week, we have 2 hours to go before the opening bell, and we have that bit of softness across the board, but not much, especially given where we were earlier this morning. Futures lower by 0.2%. You can see it's actually turned positive on the Russell 2000. Yields a bit lower as people take a look at a successful Japanese bond auction overnight, 2 hours away from the opening bell. Here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Dollar General. Those shares are surging up 10%. It just reported results. The retailer topped expectations in Q1 and boosted its full-year comparable sales forecast. That's because it's gaining ground not just with its core customers, but also with new shoppers that are trading down for more expensive stores. Obviously, that's a bit worrisome when it comes to the health of the consumer, but it's good for this company and good for the stock this morning. Next up, I mentioned this stock earlier, Bumble. Those shares are falling more than 5.5% after JPMorgan hit it with a downgrade. They say that the recent rally has gone too far and that with revenue and paying users expected to drop, they're now setting a $5 price target on the stock. And the problem, they say, is that Gen Z is just not feeling the love with this app. But I hope they do find love and maybe they go to Signet Jewelers, which is my next stock. Those shares are soaring up 13%. This is the parent company behind Kay and Zales, and it just reported better than expected earnings in Q1. It also raised its profit outlook for the full year and lifted the low end of its sales outlook. They have been making changes to their strategy, including offering more lab-grown diamonds and gold jewelry, and it looks like those changes are working for them. Lisa?
Yeah, it sounds like someone just got married. Congratulations. That was fabulous. I love it. On our radar this morning, President Trump working the phones and social media trying to sway GOP holdouts on his massive tax package as it works its way through the Senate. The bill passed the House last month, but now faces opposition from both moderates and ultra-conservatives in the Senate. The goal is, Damien, to get it to that July 4th deadline, which seems like it's going to be a pretty high task.
Yeah, no, I completely hear you. You know what's interesting? I just had somebody texting me about the carried interest and private equity, and I hadn't seen anything in that bill about any of that, about the impact on the uber wealthy tax bracket. But, you know, I guess we have to look a little bit deeper and see where these revenues are coming from and whether or not the market even cares.
Yeah, there's a real question here about what people care about more right now. Is it the tax bill with the potential ramifications for the deficit, or is it trade? And we'll get to trade in just 1 second. But Chris, from your perspective, which is more important?
I think trade is more important, but right now the narrative is all about the deficit. People are talking about the back end going up, back end yields going up. People are talking about the deficit and taxes. But the funny thing is, we've had a deficit this big for some time. The deficit looks like it's going to stabilize, yet people still talk about the deficit and how that's going to cause back end rates to go up. Not really sure what's changed, but there's a lot of narrative, a lot of talk just about why rates should go higher at the back end, and that's really the conversation of today.
On the trade front, the White House saying it wants countries to provide their best trade offers by tomorrow. Reuters reporting a letter from the Office of the United States Trade Representative asking countries to list their best proposals in a number of key areas, including digital trade, non-tariff barriers, and more. A real question of trying to expedite a time frame, whereas Henrietta Treyz said there have been 0 deals in 60 days. We have 90 days. We've got 30 more days to get 90 deals at a time when these are very tight deadlines.
Well, Lisa, as I mentioned, this is what we call going to highest and best in the residential real estate market. Our next guest can probably tell us a little bit about that. But truthfully, you know, these countries, the way their governments are structured, the way, you know, to get a deal done just because Donald Trump wants it immediately, it seems like a bygone conclusion that that's going to be a tough bridge to swallow.
Yeah.
Yeah, I think so. So to get a deal done, and you're seeing this with the EU, is there's a big bureaucracy there. You're really not sure who's leading the charge. And again, what you said earlier is, what exactly does the U.S. want? So there's that uncertainty breeds more uncertainty. It makes it difficult. I think if we can get things done in spirit, then the market will accept that. If we don't need ink on a piece of paper at this point in time, but an agreement between parties, an announcement, a framework that people are talking about, then we can take that framework and then we can push that out to other countries. The market would really like that.
Meanwhile, in other news on the layoff space, Microsoft cutting hundreds of jobs just weeks after its biggest layoff in years. Sources telling us here at Bloomberg over 300 people were told yesterday their positions had been eliminated, something we're watching just in terms of efficiency, as well as some of the big tech giants that are less capital intensive, at least on the human side, when they can potentially get efficiencies from artificial intelligence. We'll get back to that in just a little bit. This, of course, also as Disney is laying off several hundred employees across its film and TV businesses. We do want to get, however, to the main event, which is summer travel, which we all want to do. My co-hosts have already done it. That's why they're not here. Summer travel season is here. And while temperatures are finally heating up here in New York this week, the forecast for the travel industry remains a real question mark. Airlines, cruise operators, online booking sites like Expedia cutting gross booking forecasts for the year. Joining us now is someone who knows much better than I do and much better than anyone else, Marriott International CEO Tony Capuano. I'm just curious, Tony, thank you so much for being here.
Thanks for having me.
Thanks for not being on vacation, although maybe this
Somebody's
is vacation.
gotta work.
Yeah, exactly. I am curious about whether you have seen any kind of drop off in any material way, or whether that resilience that we see in the hard data really has been the theme for you as well.
So we just did Q1 earnings. January and February were gangbusters. And then you saw the consumer pause a bit in March, and we saw some softness in March. But April and even the early days of May, we started to see a little more stabilization. So the days of post-pandemic double-digit rate growth is behind us, and we're seeing more stability. But we saw globally a little over 4% RevPAR growth in the quarter. Softer in the U.S., about 3%, closer to 6% internationally. And I think that's a theme that will continue. We'll see we'll see growth, but a little more modest growth in the U.S. Every international market except Greater China, with really strong both RevPAR and unit growth.
Can you build on that in terms of what's behind it? Is it this idea that the rest of the world doesn't want to come to the U.S. because Canadians are mad? Or is it that right now it seems like the U.S. is the place where people are showing the greatest amount of discretion with respect to spending?
Yeah, there's a few things in there. Maybe I'll attack the narrative a little bit about inbound. To be sure, we're spending a lot of time with Secretary Lutnick's team, with Secretary of Transportation's team, because there is some concern from international travelers about, are they welcome in the U.S.? What's their experience going to be coming through customs and immigration? With that said, in Q1, we saw inbound from Canada down about 5%, but total international inbound for our business was up. And so the drop in inbound Canadian was offset by inbound from other parts of the world.
Tony, is this the year where ADR growth for limited service hotels actually outperforms that for luxury hotels? I mean, talk to us about consumers' relentless search for that White Lotus experience.
I think it's going to be the inverse. In Q1, the strongest occupancy growth we saw globally was in the luxury tier.
Yep.
The Select brand, slow and steady on the occupancy side, but not nearly the pricing power we saw coming out of the pandemic.
Well, I want to shift gears with you, just if I may. I know we want to talk about tourism as we head into the summer. At least that's what Lisa wants to talk to you about. But I want to talk to you about hotel investment. I mean, the U.S. saw hotel investment down 11.5% in last year. It's down 40% since 2019. Are international opportunities crowding out the U.S. market? Or are you seeing something similar abroad?
Yeah, so when I think about our growth, our investors, our owners, and our franchisees, they have all gladly and willingly decided to invest in an industry that is cyclical by its nature. The good news is most of them are very long-term asset holders, so they're not necessarily timing their investments for a quarter or two. These are assets with 20, 30, 40-year useful life. It's not lost on me that against the backdrop of a lot of economic headwinds, a lot of uncertainty, we signed more deals and more rooms in 2024 than in any year in our 98-year history. In Q1 of 25, with more and more headwinds and uncertainty, most productive growth Q1 we've had in 98 years. And so what that would suggest is both here in the U.S. and internationally, the investors believe long-term in this fundamental shift from the consumer to prioritizing travel and experiences in their spending.
Tony, a quick question. So what's the difference between what you see on the business side and the consumer side? Is there a big difference?
Business side, meaning business travel?
Business travel, excuse me.
So we think about our business in terms of three segments. The group segment, which has been the strongest segment for the last number of quarters. In Q1, global group RevPAR was up 8%. The other thing that's nice about group is we've got more visibility over the medium term because those customers tend to book out a few years. The two transient segments we have, leisure transient and business transient, which is your question, the booking window is sub 21 days today. So I can tell you what I know today, but with the caveat that trends could shift relatively quickly because we have such a short booking window. Within business transient, we look at small and medium-sized businesses and then the big multinationals. Small and medium-sized demand recovered several years ago. It was one of the first segments to recover. Big multinationals are still down double digits from where we were pre-pandemic. The good news is it's growing sequentially quarter over quarter, but modestly. In the quarter, business transient was up 2%.
And just to follow up to that, on the consumer side, are you seeing people book later and later?
We are.
You are. Okay.
We are. And you know, I'm here for the NYU investment conference. So I did the CEO panel yesterday, and we all had a similar perspective that while we're pleased with the level of growth that we're seeing, you sort of go to sleep at night and wonder what's coming tomorrow, because that consumer, because of all this uncertainty, is sort of standing on the edge of the pool saying, should I book? Should I wait? And thankfully, so far, they've been booking.
Well, this is a reason why I think a lot of people have been wondering what the read-through is for the consumer. And you've been talking about how it is down in the U.S., or it isn't necessarily growing as quickly as in the rest of the world. How do you see that manifest? Is it with respect to an inability to absorb higher pricing? Is it for people who are looking for value in the very many ways that you can put that out there?
Yeah, I think if you look at our brand strategy, it is reflective of exactly what you described. So we have brands from mid-scale all the way to ultra luxury, but we're seeing a bifurcation of the consumer in the U.S. and in many markets where we operate. That's why you're seeing us double down on the luxury end of our portfolio, because that consumer has almost an insatiable appetite for travel. It's also the reason that 2 years ago we made a big push into the mid-scale segment, which was a segment we didn't operate in just 2 years ago. And what we hear from that lower income consumer, they absolutely, just like the higher income consumer, are prioritizing travel and experience, but they need to do it through a value lens. And our entry into mid-scale is allowing us to open the aperture a little bit and bring them in.
Before we let you go, I want to talk about the other side of the equation, which is the hiring side.
Yeah.
And I remember during the pandemic when it was really hard to get everybody back. And I wonder from your perspective, especially with some of the questions around immigration and the changes that have happened there, whether you've noticed anything with how hard it is to hire people, whether that's shifted either salaries or just some of your recruitment plans.
Yeah, thankfully, some of that confidence around the job prospects in the travel and tourism sector that was shaken in the early days of the pandemic seems to have faded in folks' memory. We've got lots of candidates. Our number of open positions here in the U.S. is lower than it was pre-pandemic. Wage rates are certainly rising, but every time the job report comes out, you see that travel and tourism sector leading in terms of job creation. And so we are having good luck filling open positions.
Marriott International CEO Tony Capuano, thank you so much for being with us. Really appreciate your time.
Thanks for having me.
Great to see you, and hopefully we all get to go on vacation. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Uber has named longtime executive Andrew McDonald as its first chief operating officer since 2019. McDonald will oversee both the mobility and delivery businesses. The move is part of an executive shakeup at Uber, which includes the departure of the senior vice president of delivery and the promotion of 3 long-serving employees to their leadership team. Meanwhile, Klarna is test driving debit cards for U.S. customers as it looks to expand further into banking services and chases revenue. The fintech giant says 5 million consumers are on the wait list for the Visa-backed card. Customers will be able to make real-time transfers and deposits alongside Klarna's signature buy now, pay later service. And Coco Gauff beat Ekaterina Alexandrova in straight sets to book her place in the French Open quarterfinals. The number 2 seed will face fellow American Madison Keys, who defeated Haley Baptiste. Meanwhile, Novak Djokovic earned his 100th career win on Paris's red clay by overwhelming Cam Norrie. That's your Bloomberg Brief. Lisa?
I was wondering where John was. Now I know. Obviously, he's there. Obviously. Up next, slowing growth.
The economy is growing below potential. The markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data.
Coming up next, we'll address that with Jason Draho of UBS. This is Bloomberg. A bit softer just here ahead of the open. We see futures lower, but just lower. And they've actually turned positive on the Russell 2000, up now 0.1%. Now just down 0.1 for the NASDAQ. The S&P down 0.2%. This really interesting based on what happened yesterday, which was pretty much the same thing. Started soft and ended with firmly gains across the board after the sense that maybe things aren't so bad and why not buy the dip. Under surveillance this morning, slowing growth.
The economy is growing below potential. The markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data. Even though the stock market's had a really good run over the last 12, 18, 24 months, that hasn't stopped labor market conditions from continuing to cool off.
Here's the latest. The OECD slashing its global economic forecasts, citing the impact of tariffs and uncertainty. Jason Draho of UBS writing, the resilience of the U.S. economy will continue to underpin markets even if growth moderates. Jason joins us now, and it's kind of this two poles of the discussion. On one hand, you have Neil Dutta saying, look, the market is weakening. You can see what's going on in housing. You can see what's going on with sentiment. And then you say, well, even if it slows, it's coming from a very high base, and you can see in a lot of the earnings, people are still doing okay. So how do you parse those two poles?
Well, I think it comes down from a market perspective. Like, what's the market price and what do people think? And so a slowdown in growth is already expected. Last year, we grew at 2.7%. Consensus coming into this year was 2.3%. Bloomberg consensus is down to like about 1.4%. So that's sort of, to me, kind of the bar. Like, is the market sort of pricing that or not? So if we get some moderation, that's expected. It's really, you need to me, like, get a big downside surprise. We need a payrolls report on Friday that is like sub 100,000 or later this summer. Similar to what happened last summer, where you had that July jobs print that was really disappointing. Then the markets kind of freaked out until we see a really disappointing data point where you think, well, maybe growth is going to be sub 1%. I think the market just sort of kind of looks to a lot of this noise at this point in time.
Jason, you're head of asset allocation for UBS Wealth Management. I need to ask you about private credit and private equity here. I mean, private credit's consolidating. Private equity fundraising has plunged by more than a third over the first 3 months of the year, I think. Investors are heading to Berlin for that super annual event, to raise money. And, I just want to hear, what is your thoughts on all these continuation vehicles, deteriorating CLO demand, M&A activity falling off a cliff? I mean, what is the bullish narrative for private credit in your eyes?
Well, for private equity, at least, we know like the flywheel of how they can buy then exit. That's been sort of that's been delayed, and so their ability to exit, raise new money, that's impaired. This is could go on for a little bit longer this year, but I think that's not a fundamental broken model at all. I think for private credit, it's something where the way we kind of think of it is like from an allocation perspective, how much do you already have in your portfolio? So it's true these asset classes might be facing at least a little bit of near-term stumbles, but when we think about what our average client is doing, they're still significantly underallocated to what we think should be alternative asset classes, private markets. These are secular allocations. These are not things you should be thinking about trying to get in and out one quarter to the next. So from a long-term perspective, I think we'd say most people are still underallocated.
Jason, the linchpin for the economy for spending is labor, right? Tell me what you're seeing with labor in the here and the now, and then tell me what you're expecting in the 1, 3, and 6 months, because I keep hearing labor's going to get worse, labor's getting worse. We just heard labor is cooling, right? But we're not hearing about mass layoffs. When I talk to people, they're not saying, hey, we're getting ready to fire a ton of people. But I keep hearing that labor is going to get more and more challenged. What are you seeing and what are you expecting?
Well, I think that the general idea is that everyone expects the economy is going to slow. Tariffs are going to be inflationary and they're going to be bad for growth. We've yet to see that in the data. This gets into the kind of the data resiliency point. I do think back to a couple of years ago when everyone was forecasting a recession because the Fed's going to raise rates, and instead the data went the other way. So I'm a little bit, at this point in time, kind of the boy who cried wolf on the data. I want to see the data actually kind of roll over. I think that's sort of a consensus view among investors is that low conviction. If you're running a business with a low conviction on the macro outlook, you don't want to fire too much. At the same time, you're reluctant to hire. So the market's in it, like the labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction, there's a point where like forecasting, you just don't need that labor supply. I think companies are going to hold on to labor, hiring will be moderate. But if the consumer holds up, that sort of cycle, it won't break. And so you need one of these legs to break, and it really has to be the consumer. And the consumer's only going to break unless tariffs go up, real incomes decline, and then that's a problem. And we just don't see that yet.
When you put what we're talking about together in this idea of how to construct some sort of asset allocation, it raises the question, what's the biggest risk? Is it the question of inflation? Is it the question of potential downside risk to growth? Is it something that has to do with the risk asset portfolio, which traditionally has been stocks, or does it have to do with the risk being inherent in bonds? I just wonder, from your perspective, do you agree with so many people on Wall Street right now that stocks seem like a less risky asset class than the long end of the yield curve, given the exposure to a whole host of different risks that seems unquantifiable right now?
So I think the 30-year right now it's in, I wouldn't say its own world, but clearly the factors that are driving it are different than what's driving, say, the 5-year. If you think about the Treasury curve and the relationship between equities, it's relatively well behaved in terms of diversification. Equities, rallying, you see, rates rise at the front of the curve, and that, or vice versa. So I think that part is sort of working fundamentally. The 30-year, it's less liquid, not a big natural buyer base. It's going to do its own thing. So I'm not sure I'd want to interpret too much from what that 30 year is doing. I'd rather look at how is the 5-year reacting to the data? How is that part of the fixed income portfolio, correlating or not correlating with equities? I think for the most part, that's kind of relatively well behaved. So I'd want to just, tamp down a little bit of the information I'm getting from the 30-year.
In other words, you're rejecting this idea that 60-40 is dead and that isn't necessarily a ballast to have bonds in your portfolio.
I think, right now we're saying kind of buy up to the 5-year point of the curve, kind of that area. So that's, in that case, it's working. 30-year, we'd see kind of be cautious on sort of taking that duration risk right now because it is hard to predict.
Jason Draho of UBS, thank you so much. And I think a lot of people, it seems like, Chris, would agree with him.
I would agree, right? If today's your first day on the job, what would you be saying? Would you be saying, oh my goodness, we're going into recession? Oh my goodness, the consumer's collapsing? You would not be saying that, right? There's a lot of fear about the unknown. There's a lot of fear about what could happen. But when we look at the data, you're not seeing it in the data. You don't want to put your head in the sand and say everything, I don't see anything, right? You have to be concerned about it. You have to be respectful of it. But at the end of the day, you have to follow data. And the hard data is telling you something else. And I really do discount the soft data, and I look to the prediction markets, and they tell you something much different.
But Chris, it's not the first day on the job for a lot of traders on Wall Street, right? I mean, they've lived through these markets many, many times, and credit spreads are just not reacting to some of the risks that are inherent in the economy.
We talk about this all the time. I've never seen a recession with credit spreads at 90 basis points over, right? And if you look at the issuance that's going on, you and I could issue $500 million worth of bonds. Now I'm exaggerating, but that market is healthy and it's healthy and it's funding. And that's very, very important because credit is getting to where it needs to go. And this gets back to CapEx and our thought that where you want to align yourself is with that CapEx because the companies are issuing the debt, they can spend it. They're cautious, but they're still saying, I still need to spend, and they are.
Chris Harvey of Wells Fargo, thank you so much for spending the hour with us. Damien, you're still with me. Coming up, we've got Tom Kennedy of JPMorgan Asset Management, Congressman Andy Barr, Blerina Uruci of T. Rowe Price, and Tirupattur of Morgan Stanley as we parse through just what will be the main theme of the day, given the fact that we've got the roulette wheel of trade, we've got the roulette wheel of the budget discussions, and the roulette wheel of the economic data. This is Bloomberg.
I think the market, has probably some near-term upside.
We do remain a bit more cautious on the long end of the curve.
When we look at the equity market, we see more risks on the downside than the upside.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
What's going to drive things higher? And then it's got to be the environment and earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. 90 hours and 90 minutes until the start of the trading day, 90 days until the start of the trading month. And we are clawing back losses. A real bullish tone in the markets over the past few days with any sell-off getting bought. HSBC's Max Kettner writing this morning. Recent dips in risk assets have been very short-lived amid less supportive news flows. Our sentiment and positioning indicators are still flashing buy signals. This has been the tone that we have seen over the past few days. Right now, we are seeing slight declines. Damian Sassower alongside me today, and I'm just wondering what you make of this increasingly bullish tone, even amid so many question marks on the trade front as well as on budgets.
And then the run-up to payrolls this week. I mean, look, I have to look abroad. I have to look at all these central banks that are meeting. We have Canada tomorrow. We have Poland tomorrow. We have the ECB on Thursday. We have India's probably going to cut rates on Friday. You know, the stimulus is there globally, and the question is it going to feed through into asset valuations? My guess is, possibly.
Yeah, well, right now it also feels like people are looking past a lot of what they don't know and looking to what they do know, which is that earnings came in very strong, that there clearly is a sense that not only it was the negative data in sentiment really bearish, but it's actually coming up to the hard data. The hard data is actually hanging in there. So what is the incentive for people to truly throw away a rally that has really been the pain trade for the past couple of weeks?
Well, has it really been inventory building and front loading? I think that's what the market has to kind of parse through.
And that's the question about the data and the integrity of the data. Today we get JOLTS job openings data as well as manufacturing factory orders and durable goods. Tomorrow we do get the Beige book, which I actually think is going to be interesting, as well as the ADP. I do find it fascinating. Hold on a second. I actually think the anecdotal information right now is really interesting. I read the ISM manufacturing survey from front to back yesterday because that's what I do in my free time. Thursday we get initial jobless claims. I'm just moving on really quickly from that. And Friday non-farm payrolls. I just wonder what we can do with this, because a lot of people have been saying that the actual headline number is going to be a lot lower than it has been in the past number of years, just simply because we're in a low churn, low job creation kind of market.
My question is, what is immigration going to do to some of these future payroll prints? I mean, can we really rely on them now that Trump just got the court approval to remove 500,000 visas, 500,000 jobs? So, my question is, we're looking forward into the next, few months. Are people going to put less onus on the payroll data? Possibly.
Well, it sounds like a soup, but the soup is getting less bad, at least when you take a look at futures throughout the start of the day. What we have seen is futures clawing back earlier losses, with the Russell 2000 actually turning positive, now 0.2%. NASDAQ basically flat. The S&P futures lower by just 0.1%. In the bond market, a bid, and this is a shift from what we have seen over the past few days, and an important one. What you're seeing is a bid across the curve, in particular in duration, 3 basis points lower. Not a huge move considering the fact that this trades like a penny stock for the 30-year, but still notable given the fact that we got that Japanese bond auction that went well. 30-year yields at 4.93%. And then in the currency space, also kind of turning the recent narrative on its head. Dollar strength, who knew? You've got the euro weaker just slightly versus the dollar, 113.93. Coming up this hour, Tom Kennedy of JPMorgan Asset Management. A shifting policy calls for new portfolio construction. Congressman Andy Barr on why he says the Senate must pass President Trump's big, beautiful bill, and Vishy Tirupattur of Morgan Stanley on why he prefers U.S. assets. We begin this hour with stocks steady as trade uncertainty persists. Tom Kennedy of JPMorgan Asset Management writing, as we deglobalize, higher inflation will likely come and bonds are unlikely to be the best diversifier in a portfolio. Tom joins us now for more. Tom, so glad to have you here. Welcome.
Good morning.
So why is it that everyone is getting more bullish on stocks, but more bullish on bonds at a time when it doesn't seem like we're really facing runaway inflation?
Yeah, when we're talking about the sentiment in the market, I love listening to you guys set this up. But what's happening in the background is that betting markets have decreased its probability assigned to a recession in the next 12 months in the U.S. by 35 percentage points in just 2 weeks. This is a massive move. And for the first time since the tariff news really came out earlier this year, you actually now have betting markets recession probabilities below what economists are suggesting. So this is a new regime. I think it feeds into this bullish sentiment that's happening. Things are shifting so rapidly. And to us, that makes a lot of sense.
Well, Tom, why do you suppose that is? Is that because of the fact that they think deals are going to get done, that Trump's going to do a deal with India, they're going to do a deal with South Korea, with Japan?
I think that's part of it. I do think the Trump administration has suggested that the negotiations can happen, and they've backed away from some deals. But most importantly, you're still seeing inventories get to America. Yeah. This year so far, shipping from China to America is up 6% relative to last year. Now, there's lots of volatility month to month, but We don't have this embargo risk really. The second is that spending is slowing in Chase, where we get the best data on the planet. Spending is slowing, but more natural when you have high interest rates. And third is corporate margins, which you guys hit on, are still extremely healthy. So the risks of layoff are relatively low if we can work through this tariff risk. So to me, a lot of this volatility is related to the Trump administration, but things are still working, things are still progressing, and the hard data is turning really nicely, or at least not coming down towards the soft data.
Tom, I want you to put your real estate hat on for me. Operating expenses in real estate, through the roof. Do you think tariffs are going to be inflationary for the U.S. economy?
If they are, they support real estate in a really interesting way. The way that real estate works and you move through a higher interest rate environment is the first phase is we have to reprice those assets. And we really have done that. You saw commercial real estate prices move down about 25% as the Fed hiked rates. Very aggressive. But to your point, now costs rise, higher inflation, higher interest rates make it really hard to build. And now we're walking into a supply problem for real estate.
There we go.
So as we move out over the next 2 to 3 years, you're looking at really no supply coming across office all the way to residential. And across all of those, new starts are down almost 75% from the peak. So this problem of repricing now moves into a phase where supply becomes your bigger problem. And most real estate investors would sit here and say, if you look back through history, too much supply is always the problem for commercial real estate and real estate in general. But we're walking into a phase where there's not a lot of supply.
This actually goes perfectly to this question of inflation and what the real risk for bonds actually is. It's really good that you're bringing up real estate because that's the argument people bring for disinflation. Look at what you see with the glut of homes for sale. Wouldn't that lead to lower pricing? You're making the argument, not really. On the flip side, you're saying that this is people pricing out recession. So is the move that we're seeing in bonds a positive story about growth or a negative story about stagflation with higher inflationary risks on the horizon?
Yeah, I think you're running the risk that stagflation is the scenario we walk through. Now, that's a big word we all use, and it never gets defined. What I'm describing as stagflation is a world where growth can remain consistent with what we've experienced for maybe the last 18 months, but inflation is not below 2%. It stays a little bit above 2%. And the question becomes, what do central banks do in this environment? My time at the Fed inflation was below 2% the entire time. Growth was the thing that decided if they hiked rates or cut rates. And now if inflation stays above 2%, it's not that simple. And we need to price more interest rate volatility, which means it's hard to price new financing. And you also have an environment now where rates are just higher for a period of time. It comes back to this portfolio construction piece. That's where you started. Portfolio construction has to be different than what we had in the regime before COVID, where inflation was persistently below 2%. If we're going to see inflationary pressures move through this economy, interest rates will be higher, and maybe they won't be the same diversifier that they were.
So when you say portfolio construction, a lot of people would simply say, okay, you don't like the 60-40. And this is another way of saying it, right? Is there a more sophisticated way to put it in terms of how you have to think about what risk is, what you're trying to mitigate, what your new ballasts are at a time when there is this sort of uncomfortable inflation with slowing growth?
Harry Markowitz created the 60-40 portfolio in the 1950s. It didn't get broad-based adoption until the late 1990s. Why? Well, something critically changed in the late 1990s and in the early 2000s. The era of globalization hit its golden era, where any input I can get throughout the world, I'll take it. Send it to me. I don't care what the consequence is. But now you fast forward. COVID hits. Oh, wait, we need to keep supply chains a little more resilient. Now we have rising geopolitical risk. And then we can add on the deficit woes, which a lot of people want to jump to, but we're not seeing meaningful differentiation in how the dollar is being used globally. But in that world, if peak globalization is behind us, inflationary pressures are higher, and the same diversifiers won't work. And really what I'm, rubber hitting the road, the Fed doesn't have as much control of the long end as they've had for most of our careers sitting at this table. So something is a little bit different. As we sit and breathe here, this is something to talk about the rest of this hour. The 30-year real rate is at the highest level it's been since we've had a 30-year tip. Why? Why are people not jumping into it? Well, It's because there's lots more uncertainty. Things are changing.
Tom, and it's no man's land up above 270 on the 30-year real yield. I was looking at that yesterday, but you're talking Markowitz mean variance optimization. That's squarely in my wheelhouse. So let me ask you this. Alternatives and the role alternatives play.
Yeah.
But the thing that I have a problem with is the illiquidity of alternatives. Are investors that you're speaking to that JPMorgan Asset Management is taking care of, do they understand that when things get tough and the gates go up, they may not have access to those funds?
JPMorgan did this amazing family office survey last year. So the wealthiest families, how much of their portfolio is in alternatives? When I asked this question at like a cocktail party, people have no clue. 45%. Mm-hmm. So the wealthiest families, endowments, are able and already willing to give up the liquidity. When you look at the average person in, say, a wealth management office, 5% of their assets are in alternatives. So there's room to grow. The second point, though, is the asset management community is finding ways to add you more liquidity.
Oh, yeah.
Think about non-traded REITs as an example, where you can provide monthly liquidity to an investor. And now it's our job to find the assets that can optimize that liquidity. And in real estate, as an example, for a non-traded REIT, residential and industrial properties have multiples more liquidity. They turn over a lot more in the market than, say, office or data centers. So this is the optimization and evolution that's happening.
Okay, and we need to move on, but just quickly, this is something that starts to worry me after having lived through 2008 and 2009. When you start giving something the appearance of liquidity that is not inherently liquid, alarm bells start going off. At what point are we going to just slow walk back into that kind of paradigm of liquidity mismatch?
Yeah, and this is an important thing. It's not completely give up on liquid bonds. It's not completely all in on quote unquote less liquid ideas. But this is the balancing act that has to happen. And when I look at that paradigm between family offices and average investors, that's just a chasm that's too big. There's room for all of these products to coexist, but I think the shift that's most likely to happen with higher inflation, higher interest rates, is this move towards alternatives and balancing that liquidity, Damien, to your point.
Tom Kennedy, we could talk about this for an hour, and luckily we have an hour. We'll be talking about a lot of things going forward. Tom Kennedy of JPMorgan Asset Management will be sticking with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Dollar General shares are rising more than 10% in the pre-market. The discount retailer reported first quarter profit and sales that topped analyst expectations, and it boosted its comparable sales forecast for the full year. Dollar General also said it expects to mitigate a significant amount of the tariffs currently in place. Meanwhile, Africa is set to be the largest beneficiary of the $200 billion the Gates Foundation plans to give away over the next 2 decades. Co-founder Bill Gates made the announcement at an African Union gathering in Ethiopia on Monday. The organization said last month that it plans to give away the money over 20 years before shutting down in 2045. And President Trump has changed his official portrait less than a year into his second term. The new image carried on the White House's social media channel swaps the turquoise tie for his favored red power one and switches the background from the U.S. flag in what appears to be a stateroom to black. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. News you need on a Tuesday. Up next, the morning calls plus Congressman Andy Barr on why he says the Senate must pass President Trump's big, beautiful bill. That's coming up next. This is Bloomberg Surveillance. We just had the best month for a May going back to 1990. And meanwhile, people are saying, should we sell? And the answer, at least on the outright, seems to be no when it comes to stocks, given the fact that we've seen that rally. When it comes to bonds, there is another story. And the 30-year is the question. Who wants to buy a 30-year bond with a yield near 5%? Getting a little traction today, but still clawing really awfully close to that 5% level, which has been the pain point. We'll get to that in 1 second. Time now for the morning calls. First up, Piper Sandler raising his price target on Lululemon to $315, looking for the company to report better than expected earnings on Tuesday. Next up, Morgan Stanley lowering its price target on Campbell's to $35, expecting a challenging year ahead if tariffs stay in place. And finally, JPMorgan upgrading Pinterest to overweight, pointing to solid user growth and better ad capabilities with the ability to click on links and shop directly from Pinterest, so I hear. Turning to policy, President Donald Trump trying to sway Republican holdouts on his one big, beautiful bill. Trump posting on Truth Social, I call on all of my Republican friends in the Senate and House to work as fast as they can to get this bill to my desk before the 4th of July. Republican Congressman Andy Barr of Kentucky voted in favor of the president's bill last month, and he joins us now. Congressman, thank you so much for being with us today.
Good morning, Lisa.
Good morning. So I want to start with asking about the deficit, and I'm watching that 30-year bond yield, as everyone in Washington, D.C. is. Do you believe what President Trump said on his Truth Social post last night, that this doesn't add to the deficit, even though you have a whole host of different estimates saying that it will add $3 trillion to the deficit over the next 10 years?
Well, Republicans are also watching the 30-year. We're watching the 10-year. We're watching instability in the bond market. We're looking at weakness in demand for treasuries. But blaming the big, beautiful bill for weakness in the treasury market or instability in the treasury market is like blaming the firefighter, the arsonist blaming the firefighter for the inferno. We just went through 4 years of a drunken sailor's spending spree by the Democrats that put us, way behind the 8 ball. Also COVID, and there was some bipartisan spending associated with COVID. But it's very rich for Democrats to accuse Republicans of fiscal irresponsibility when we just went through this spending binge that produced 40-year high inflation, 20% increase in prices. Look, the bottom line is we know we have to achieve greater fiscal discipline. And frankly, we need some bipartisan work on mandatory spending reform. But what we also need is economic growth. We will never balance the budget. We will never get our fiscal house in order without robust economic growth. I believe, as Kevin Hassett has argued, that this legislation, this one big, beautiful bill, could produce, along with the deregulatory project, along with more energy production in the United States, that we could achieve that 3 to 4% GDP growth. That's the kind of dynamism that is not accounted for by the Congressional Budget Office and some of these static scores.
So let's talk about that, why it's not being accounted for that in places like the Committee for a Responsible Federal Budget that expects this to increase the deficit and says that it only cuts spending by 0.8% of GDP. Where are people not including growth that you see as being part of this bill?
Well, the CBO just doesn't. They were off $1 trillion, underestimating revenue reflow that came as a result of growth from the Tax Cuts and Jobs Act in 2017. The CBO has a terrible track record of not including the dynamic impacts of these tax cuts. And in this bill, not only does it make key features permanent, providing that certainty and stability for private sector investors, but the business tax cuts are really the rocket fuel that are included in the bill. So bonus depreciation for 5 years, pulling forward all that CapEx. There's a reason why the Atlanta Fed is projecting 4% GDP in the second quarter, because businesses and business optimism is increasing because of anticipation of R&D, interest deductibility, increasing the small business pass-through deduction from 20 to 23%, making that permanent. So these business tax cuts are really increasing business sentiment. And I think, again, pulling forward that investment that can really allow this economy to take off.
Congressman, you sit on the House Select Committee on the strategic competition between the U.S. and Chinese Communist Party. What is going on between President Xi and President Trump? Where are we with that relationship right now?
I think President Trump is the first president, Republican or Democrat, in our lifetimes who has taken the threat from China seriously. Under this president, no more unfair trade deals, no more Chinese fentanyl poisoning our people through the southern border, and no more spy balloons coming across the continental United States. Deterrence, peace through strength, that is the idea. The big, beautiful bill, to the extent we increase spending in there, there's more military modernization dedicated for the Western Pacific Theater. That's what we need. We need to win this competition. We need to be the best version of ourselves. We need to enhance, of course, our investment in defense, but we also have to be strong economically, and we have to grow. China has its problems. We have a debt problem. But we can produce growth by being free market capitalists.
There is a question, though, in your quest to be free market capitalists of both getting revenue from tariffs that have to do with continued trade, albeit with something of a tax, versus decoupling in its entirety. And what you see from a lot of the data right now is that trade is going down quite considerably, and exports from the U.S. are going down quite considerably. So how do you account for some of the revenue and the growth from some of these tariffs if you're also talking about potentially decoupling in certain key industries between some of the biggest economies out there?
Well, you know, I liked what Jamie Dimon said at the Reagan Economic Forum in California. When he said I'm being associated with that. When he talked about, you know, strategic de-risking from China on those national security sensitive industries, not complete decoupling on things like tennis shoes or basketball shoes or apparel or things that do not implicate national security. What I would say about in general, as a free trader, why I support President Trump's agenda is because of the enormous potential that this has to actually open up markets for American exporters. If we can open up India, for example, and reduce their protectionism and their trade barriers against our exporters, that is massive. And if you think about it, from where we were on Liberation Day to now, we're back in basically a bull market with a correction embedded. Every trade deal that is inked from here on out is, again, jet fuel for the economy. We get the certainty of trade deals in place with more market access for American exporters, plus deregulation, plus the tax cuts. I do see 4% GDP.
What do you think the Senate is going to do to change the bill that you would be okay with in terms of cutting salt tax deductions, potentially adding back and potentially even increasing some of the CBO's score for the deficits with respect to Medicaid? What are you going to be okay with?
Well, look, we've got to get this done. I think we have to have an ability to compromise on some of these details, whether it's SALT, whether it's Medicaid. I welcome fiscal hawks in the Senate saying, hey, we need to do more on the spending restraint side. So Ron Johnson, my colleague, Rand Paul from Kentucky, good for them for asking for a reduced size and scope of the federal bureaucracy. I like that. Let's codify some of the DOGE savings. But at the end of the day, we have to get this done and deliver this. 77 million Americans voted for this pro-growth agenda. I think at the end of the day, we'll come together, we'll get it done.
Congressman, thank you so much for being here.
Great to be with
Congressman Andy Barr here in New York. And this really is the key question, Tom. Ultimately, what gets done in what form and whether it's going to generate more growth than people are expecting, because that really is one of the key questions at a time where everyone seems to be focused on the deficit.
Yeah, Congressman Barr, you're really separating out the issues for investors here, too, which is can we balance that growth with reduction in expenses so that the Treasury market will function? And you did it very quickly, but you highlighted some of these critical connectivities between the U.S. and China, which may have some national defense issues. So much on your plate to deal with. Well done.
This is the reason why. This is the reason why, honestly. I think a lot of people are having a hard time understanding the bill and understanding exactly what to pay attention to, Damian, given all the potential competing headlines.
Yeah, no, look, the deteriorating relationship between Xi and Trump, is it really deteriorating? We don't know what's really going on inside the White House, inside the Oval Office, inside the West Wing. So, it's anyone's guess at this point.
And it's anyone's guess what some of the data is going to point to as well. Coming up, we're going to be speaking about that ahead of Payrolls Friday with Blerina Uruci of T. Rowe Price. We've got eco data that includes the JOLTS data that we get later today. Fed speak, of course, non-farm payrolls. This is Bloomberg. The closer we get to the start of the opening day, what you can see is any losses getting clawed back. Right now, you can see futures pretty much unchanged, actually in the green for the NASDAQ and the Russell 2000 up now 0.4%. S&P futures basically flat. If you take a look at the bond market, a rally there after a successful Japanese 10-year auction. What you can see is that rally even in the 30-year Treasury that nobody seems to want to buy. Yields lower by 3 basis points, 4.93%. The 10-year 440 still solidly sub 4% on that 2-year. 1 hour away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Constellation Energy. Those shares are soaring nearly 10% after it signed a giant energy deal with Meta Platforms, the Facebook parent company, agreeing to buy nuclear power from Constellation's Clinton plant in Illinois for the next 20 years. All of this meant to fuel Meta's AI operations with clean around-the-clock energy. The deal could even lead to them building a brand new reactor at the site. So the AI spending showing no signs of slowing down. Next up, we have the latest retailer to report, and that is Signet Jewelers. Those shares are soaring now, up 17%. This is the parent company of Kay and Zales Jeweler, and it just reported better than expected earnings in Q1, and it also raised its profit outlook for the full year. They have been making changes to their strategy, leaning more into offering lab-grown diamonds and golds, and it looks like that strategy shift is working out for them. And last up, we have Dollar General. This was an interesting one. Shares are soaring nearly 10%. They also reported better than expected results in Q1 and boosted their full year comparable sales forecast. That is because they're gaining ground not just with their core customers, but also with new shoppers that are trading down from more expensive stores. And when it comes to tariffs, that was the big worry for Dollar General since it imports heavily from China. But they said that they're going to be able to mitigate a significant amount of the tariffs that are currently in place. Lisa?
Yeah, thank you so much, Jaira. I was just reading more about Dollar General saying that they did caution that consumer spending could be pressured by tariff-related price increases, but managing to move forward with this. But really interesting, Tom, the fact that you get some sort of better than expected results because of trade downs at a time when people are cost conscious.
Well, we're actually seeing that in our real estate portfolio too. Retail platforms are actually holding in okay, but what you're seeing the customer do at our properties is trade down to more away from discretionary ideas to non-discretionary ideas. So, and this was actually happening before the tariff news. So there is a slowdown in the consumer that's happening. We would characterize it more as normalization rather than a meaningful slowdown, though, in the grand scheme of things.
Which is the reason why people are parsing through the economic data to understand whether it's going to be north of 1% or sub 1% when it comes to growth. With that economic data, as well as Fed speak on deck, Michael McKee of Bloomberg Economics, what are you looking for in a really packed week for economic data?
Everybody's going to be focused on jobs, Lisa, and then in the coming weeks, we're going to be looking at inflation, the two pillars of the Fed's dual mandate. We had some Fed speak earlier this week, yesterday, from Chris Waller, the Fed governor, and Austin Goolsbee from the Chicago Fed, and both of them basically suggesting something called good news rate cuts were possible by the end of the year. And here's what they're talking about. Waller is looking at the inflation numbers and looking at the idea that it is important that inflation expectations stay anchored. And if they do, a one-time move in inflation because of the tariffs would not affect things. And here's the problem. The University of Michigan numbers, as you can see, show big increases in what people think is going to happen over the next year and the next 5 years in inflation, but market-based measures show much, much less, that inflation is contained. And Waller is saying basically he believes the market-based numbers. So if we get a one-time move up in inflation, it'll be okay. Goolsbee and Waller both watching the other side of the mandate, which is unemployment, which the Fed is going to look at as a signal for whether the economy is significantly slowing. And right now, we don't know because it's way up in the air, although there are some questions about whether this is going to be the kind of last hurrah for the labor market. JOLTS out in just about an hour and 20 minutes. Their job openings expected to fall. ADP is expected a very slight increase in jobs, but they were way off last month. Payrolls supposed to come down a lot. It's unemployment that's holding in steady. And that's what everybody's going to be looking at to see if there is any kind of movement there that would disturb the Fed. So watch for the jobs report on Friday. Watch for the inflation numbers coming up ahead. And if you want to bet on a Fed rate cut at the end of the year, good luck to you.
Michael McKee, thank you so much. I think a lot of people have thrown their hat in that ring and then taken it out and then thrown it back and then, basically sat on it. Right now, Blerina of T. Rowe Price joins us to talk about that economic data ahead. Blerina, what does a good jobs report look like? What does a bad jobs report look like, given the fact that a lot of people are saying the headline number is going to come down quite significantly?
We also expect a deceleration in the pace of employment growth this year. I think that's been quite well telegraphed because we have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either because we did have those post-pandemic shortages of workers. And I think companies are very cautious about talent. So I think the labor market equilibrium is quite uneasy. A good news report for me is one where the unemployment rate does not tick higher. I think this is what would really concern the Fed, broad-based layoffs. And also we need to see in this uneasy equilibrium, is the wage growth and wage inflation rate going to slow or stay sticky where it is? I think we need wage inflation not to accelerate from here. We'll be watching those inflation expectations very closely. Indeed, I think it was a very interesting choice of words by Governor Waller to say that this hit to inflation is going to be a one-off shock to the price level and not persist, because the last time the Fed went on that assumption, we all know what happened. So I think we got to watch very closely those inflation expectations and what happens to wage demands once the effect of higher tariffs hits consumer prices.
Blerina, the Fed has made no secret about its asymmetric view on policy rates and inflation, opting to ease first and ask questions later. Yet despite that dovish bias, I think the market's only pricing in, 2 cuts before the end of this year and a terminal rate of 3.25 by the end of next. Is the market right?
The market has been oscillating a lot in terms of price cuts for this year, and I think it's been responding to whatever has become the dominant narrative. At one point, it's the growth scare, then it is the inflation shock from tariffs. Now it's the fiscal package. I think for the Fed, it's going to be very tough to cut interest rates this year. I still have 2 cuts in my forecast towards the end of the year, but I think that window might be closing quite quickly for the Fed. If we don't get a meaningful deterioration in activity and in the unemployment rate, and the inflation shock from tariffs hits starting from Q3, which is my baseline scenario, I think it's going to be pretty tough for the Fed to justify easing policy with accelerating inflation and a labor market that is holding up.
Yeah, Blerina, really nice. What's the differentiation from you for a demand side driven report on Friday versus a supply side driven report on Friday? And what I'm getting at is the immigration numbers into this country are abysmal. Mm-hmm. The border is effectively closed. And a big piece of what you suggested is during COVID, immigration filled in that supply gap. Are we on the other side of that? Or is this really a supply issue or a demand issue in your mind?
So I think it's both, but let's unpack this because I think it's going to be very, very important in terms of what happens with the path of the unemployment rate for this year. So we have a slowing in demand for jobs, and we see that because the vacancy rate in the JOLTS has been declining. What we don't have is mass layoffs so far. So all this uncertainty about the business climate has not led to firms laying off workers. We also have an administration with a policy to restrict labor supply, foreign labor supply. That we know because those border crossing statistics that you mentioned, they've come down a lot. We also see the labor force participation of foreign-born workers declining significantly since the end of last year. So we know that. And I think this declining labor supply is coming at the same time as the demographic forces in the US with the baby boomers retiring. So the supply of workers in the economy is going to slow down a lot this year. What we saw post-pandemic with increase in net foreign-born workers in the economy was that we entered some kind of virtuous circle where we had vacancies, we filled those, extra workers created more aggregate demand and so on, and the economy was able to sustain above-trend growth for quite some time. I think we'll be seeing the opposite of that this year. But now, if we don't have broadly based layoff and we have a declining labor supply, the unemployment rate in the economy is probably going to stay sticky or trend lower. And that's going to be a supply effect. And I think if you're the Fed and you don't see that increase in the unemployment rate or the SAM rule being breached, you're going to be pretty cautious about cutting interest rates in this environment with heightened inflationary risks.
Yeah. How much of this supply issue, Blerina, is impacting the expectations for growth in this country?
I I would say a fair bit. I think it's that and uncertainty about the climate of doing business, uncertainty about what's going to be in this fiscal bill. Again, this is an interesting one because there are lots of components of the bill that came out of the House that support spending and investment with 100% capital depreciation and expensing for investment and so on. But you also have Section 899, which you all have discussed in depth today. I think that makes it harder for FDI coming to the country because they will not know which countries will be in the list and what different types of capital, how they will be treated.
Yeah, Blerina Uruci of T. Rowe Price, thank you so much for being with us. It really has been this confusion. We keep talking about the negative sentiment. The data comes out. It's sort of a tale of a lot of different aspects, and it doesn't actually speak to a materially weakening labor market aside from just low hiring, low firing.
Well, Lisa, we've had a lot of people come on today railing all over the 30-year. And, I've just done a little back of the napkin calculation here. I'm using cross-currency basis swap spreads. You can get a 30-year JGB hedged into dollars, 6.85%. So why would you buy a 5% 30-year in the U.S. when you can get 250 basis points more by buying JGBs and hedging out the dollar exposure?
I love how you're mapping that out as we talk. He's sitting there calculating this. But Tom, to that point, I think the idea of feelings versus reality, there have been some really fundamental changes that have been going on under the hood. And I wonder how much some of the sentiment has to do with entry-level people not being able to be hired or not getting jobs right out of college. Whether there's been a weakening that hasn't been as pronounced in the numbers as it has in how it feels for certain people when they go out there.
Yeah, this polarization concept you can now see in the way you survey Republicans versus Democrats, for an example. During the Biden administration, Democrats felt their consumer sentiment was better than Republicans. We're all living in the same United States, but sentiment is a completely different narrative. I think it helps explain why soft and hard data can diverge and why most economists are now pulling back some of their confidence in what the soft data today tells you about the future. Those surveys are just not as meaningful. But Blerina really hit at a really critical development that's going on in this country that really hits at Congressman Barr. We need growth, but the simple ways you get growth are productivity and people. And at the moment, Blerina didn't give the number, but you're seeing border encounters at the Southwest land border at 10,000 per month. Last year, in the month of May, you were at 200,000. The year before that, something similar. So these are challenges for the administration.
Well, Lisa, the remittance data out of Mexico just printed, right? It's falling at about $1 billion a month. That's $1 billion a month. And Mexico relies heavily on remittances from the U.S.
I'm glad that you said that. Actually, I was just looking at that yesterday. The remittances to Mexico from the U.S. fell 12%, which is the biggest drop in more than a decade. And that really goes to this question of, are there the people here to even be sending back, let alone, just what that means for the respective economies? Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. A vote count is underway to determine South Korea's next president. According to an exit poll released soon after the voting ended earlier this morning, Democratic Party nominee Lee Jae-myung is on track to win. The final voter turnout for the election reached its highest since 1997, according to Yonhap News. Meanwhile, Microsoft has cut an additional 300 jobs just weeks after its largest layoff in years, where the tech giant slashed 6,000 roles. The cuts underscore the industry's efforts to trim costs even as it plows billions of dollars into artificial intelligence. Microsoft's previous layoffs fell hardest on software engineers, but it couldn't be determined what kind of jobs were affected this time around. And Coco Gauff beat Ekaterina Alexandrova in straight sets to book her place in the French Open quarterfinals. The number 2 seed will face fellow American Madison Keys, who defeated Haley Baptiste. Meanwhile, Novak Djokovic earned his 100th career win on Paris's red clay by overwhelming Cam Norrie. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Wonderful work this morning. See you tomorrow. Right now, up next, setting you up for the day ahead. Plus, Vishy Tirupattur of Morgan Stanley on his preference for U.S. assets at a time when so many people are saying sell America. This is Bloomberg Surveillance. The more everything changes, the more everything stays the same. Still budget negotiations down in Washington, D.C. Still a question around what kind of trade deals are going to get done. And still a question around the economic data. What does it mean? What we can see is what it means in markets is a pretty sanguine backdrop, pretty somnolent this morning, flat pretty much on equities. And what you're seeing is a little bit of a rally in bonds, but that too is fading as the day goes on. You're seeing something counterintuitive in the currency space also. Little bit of dollar strength, although that comes after a massive dollar weakening throughout the year, down more than 8% for the DXY, the dollar index, as people look to the questions of what U.S. policies mean for both growth and the fiscal overhang. Counting down to the opening bell, this is what we are watching. 10 a.m. we get durable goods and JOLTS, plus Fed speak from Goolsby, Cook, and Logan Wednesday, ADP employment data and ISM services on Thursday, the trade balance, and another round of jobless claims. Watch the continuing claims in particular, plus German Chancellor Merz meeting Trump at the White House. And on Friday, the big one, or it should be the big one, which is May payrolls. And I say that because so often it seems to not actually matter at these kinds of what does the data mean moment. Turning back to markets, Tirupattur of Morgan Stanley writing this. Despite unprecedented policy uncertainty, the global economy is still in expansion mode. We believe that U.S. assets will remain compelling versus the rest of the world. Vishy joins us now for more and to tell us why cricket is the best sport out there, which we can get to in just a minute. But Vishy, I want to start with this idea that Morgan Stanley's put out there. Thought it was a fascinating argument over the weekend. Essentially, buy everything about the United States. Buy bonds, buy stocks, just don't buy the dollar. How do you do that?
So what we are saying is that the investing is really about relative value and what's in the price and what's expectations going forward. I think we can make a pretty good case for each of these markets, the bond market, for the equities market, and for the credit markets, that the better opportunity is in the US versus the rest of the world. At the same time, the strength of the dollar, that has been a big thing for many years now, for well over a decade. We've had yield differential and growth differential and policy certainty, at least less uncertainty about policy. All of those things are no longer that compelling. So we expect the dollar weakness to persist for some time. So if you are a US investor, US dollar investor, great. If you are a non-US investor, the U.S. opportunity is still the better opportunity, but hedge your currency. For years, putting money in dollars, putting money in U.S. assets, and not hedging actually was pretty good, worked out pretty well. Yep. If you put money in during good times in U.S. equities, if markets start to deteriorate, allocate to treasuries, but don't hedge currency, it was a pretty good strategy by and large in the aggregate. So that not hedging for non-U.S. dollar investors we think will be a problem. So what we are recommending is people hedge the currency exposure, but still we have the largest market. We have if you take the U.S. Treasury market is 10 times the size of the European government bond markets, say all AA plus European government bond markets, you add them together, U.S. Treasury market is 10 times the size. Yep. U.S. stock market is 5 times the size of the European stock market. U.S. credit markets, investment grade markets, 4.5 times.
I'm laughing because everyone around the table is like, well, so go ahead, Damien.
Vish, you're the chief fixed income strategist for Morgan Stanley, and I love it when rate strategists start talking about currency risk premia, and that's exactly what we're doing right here. And I know I'm sitting in the chair right now, but my day job is I run emerging market fixed income research for Bloomberg Intelligence. EM local government debt up 9% year to date. Best performing asset class in global fixed income. What are your thoughts on it?
We are pretty constructive on EM, actually. Actually, EM local currency as opposed to EM hard currency. We like your EM local currency. EM is, as you know, EM is not one blob. There are very idiosyncratic stories across the board, but I think broadly speaking, we are pretty constructive on EM fixed income in general.
Hold on here, though. So we're liking EM now. Bring it back to the U.S., though, because I want to talk to you a little bit and hear your thoughts about where there is value on the Treasury curve. We've been talking all morning about the 30-year. I'm looking at the chart here. You got 30-year real rates, 2.65%, near the highs we've seen in the history of the TIPS market. Are people buying it? Why aren't they buying it?
So I think the best opportunity in the Treasury market is in the steepener trade.
Okay.
So what we'll consider 330s, 230s. We expect that we'll find, I think where there's a significant mispricing is in the number of rate cuts that are priced into the Treasury market today. So roughly about 2 cuts are priced this year, about 2 cuts, a shade around that, priced for next year. We think that, our economists expect no cuts this year and substantial number of cuts, 7 cuts next year.
Wow.
So if the world pans out according to how we are imagining it, which means the economy slows but doesn't tip over into recession. So economy slows to 1% in 2025, 1% in 26, and unemployment rate doesn't really spike because unemployment rate is a function of both the labor force supply. So migration has a big impact on it. We expect an unemployment rate to tick up but not spike. So we put all those things together, we think there's a good case for Fed not to cut this year, but having to cut a lot more next year.
So I understand the steepener trade in that, but historically, if someone sat here and said we're going to cut 7 times in the next 18 months, long duration is the play here. How come not just buy the outright 10-year?
No, we're not, absolutely we would be recommending that as well. Our expectation is 12 months from now, 10-year Treasury will be in around 345. So it's a pretty substantial rally. In fact, our big case for fixed income in general is really the duration rally. So it's a 100 basis point rally in 10-year Treasury, roughly. And that's a pretty significant uptick.
Just to put some underscore on this, are you saying that all the people saying, sell 30-year Treasuries, short 30-year Treasuries, guess what? This is going to be absolutely the risk asset. You're taking the other side of that?
So what we are saying is that what will eventually matter is how the growth expectations and the policy response, the Fed's response to those growth expectations, we think currently they are off. And if the policy turns out to be the way we are anticipating it to be, we think duration is a good bet.
So buying 30-year yields.
The 30-year yields is a 2026. No, I do want it. Right? I mean, it's a 2026 trade as opposed to 2025 trade. So best opportunity for buying the long bond would be later in the year, early next year, as opposed to now, when some of the uncertainties that surround that, we would have seen much. Hopefully, some of those things will be clear.
Vishy, we're going to have a special hour devoted to not just this, but also your argument on cricket, which I know you've devoted a lot of time to come in here and defend it from the ruthless attacks from baseball lovers last time you were on. Vishy Tirupattur of Morgan Stanley, thank you so much for being with us. Honestly, I just have to say thank you, Tom Kennedy. Thanks you so much. And thank you so much, Damien. Thank you. Do you want to come back tomorrow and do it again?
I think I am.
Oh, that's fantastic. I'm very much excited. So Damien's going to be with us coming up tomorrow. Also, Savita Subramanian of Bank of America, Kate Moore of Citi, Jim Karen of Morgan Stanley, and EU Commissioner Valdis Dombrovskis. Don't miss that as a real question emerges about how close the U.S. and Europe are to a trade deal. This was Bloomberg Surveillance.